Hello everyone. Good evening to all. Welcome everyone in this session. I hope you all are fine and I'm audible, visible, everything is good. Let me check. Okay, everything is all fine. Now, so today we have to start part 2. So yesterday we completed part 1 and in part 1 we completed the all the units of module B and we started module C and we completed 5 units of module C as well. So today we'll do the rest part of module C and module D, all about compliances. So if you have not watched the previous session, so it's the recording is still there, so you all can watch according to your pace. And if any doubt, any confusion comes to your mind, do drop your genuine response in the comment section box. I'll address them. All right. So those who are watching this session for the very first time, one request from you all is that please subscribe the channel. And if you feel sessions are helpful, then you can like the session as well. So myself, Saloni Gupta, your ABM, ABFM, and Central Banking educator in English medium. All right. So let's start our session. So we completed till unit number 22 in yesterday's session, and from 23 we have to start our session. That is all about risk management and credit rating. Now, when we started module C, what we have seen that it's all about the credit management, overview of credit management. We have seen then credit appraisal. Before credit appraisal, we have seen loan policy of the bank, then credit appraisal, then working capital finance, long-term finance, then after credit appraisal, credit disbursement, that is credit delivery. Then after that, credit control, credit monitoring, LRM. Now, and today we'll start from risk management. So, of controlling the credit, monitoring the credit, you have to face different types of risk. So, how you will going to manage your risk and all about credit rating agencies in India as well as foreign. Now, so credit risk is what? Credit risk is the risk that is done by the default from the borrower side. So if your borrower has done any kind of default, borrower is unable to pay its dues, the bank is unable to recover its dues, that is called risk. And that type of risk is known as credit risk. Now, so in credit risk, in compliance risk, we have many other different types of risk. Now, operational risk. So this we have already done yesterday. When in such type of risk, three factors, these are the three factors that will bring such type of risk. Now, what are those three factors? People, process, and system. The employees who are working in your company, in your bank, if they are not caliber enough to handle any task, okay. If the process you are having very delayed process, the loan documentation, loan delivery takes a lot of time. And system, when your IT system does not support you, when your uh, system or when your any other technology does not support you, that is why these are the factors that bring operational risk. And some other outsider factors like natural calamities like flood. So example of these risks are loss due to fraud, disruption of business due to natural calamities. Now, market risk is what? It is the risk that occurs from the fluctuation of the market. Market fluctuation means inflated prices are there, inflation is there, recession is there, demand and supply is moving very high. So that is all about market risk. So interest rate risk, exchange rate risk. So it is the from adverse market movements of all these rates. And credit risk is all done when your borrower has not paid you the principal as well as the interest amount. So non-payment of principal plus interest by the borrower. Now, next we have some of the factors that also affect a credit risk. So one factors are external and another are internal. Now, external factors means these are uncontrollable factors. You cannot control them. The bank cannot control these factors. Whereas internal factors are those factors which are controllable. So if bank wants, bank can control these factors and bank can minimize the risk, but not in external factors. Now, so what are these factors? Like main external factors are when credit portfolio, the quality of the credit portfolio, the bank has over concentrated its loan, are the exchange rate, interest rate fluctuation, government policies changing in every few days, okay, protectionist policy, then political risk. So you basically you can say it arises from pestle. What is pestle? Political, economic, social, technological, legal, and environmental. Now, internal factors are those that are within your control, like the concentration of credit. So if bank want, bank can give more credit to any specific sector. If bank want to control, bank can control it by giving less credit, less disbursement to any specific sector. Then a particular segment of geographical region, excessive lending to cyclical industries, ignoring purpose of loan, faulty loan, repayment structuring, deficiencies in the loan. If once a borrower has asked you 10 crore, now you have checked the borrower's history, the company of the borrower, and you have found that the financial statements are not true, not representing the true and fair view. So in that case, what you will do, you will reject the loan appraisal. You will simply reject the credit appraisal. So that is what that is in your hands. So these are controllable. Like low quality of credit appraisal. Uh, the loan officer has not properly done the credit appraisal and disbursed the loan, and after that, the credit risk arises. So these are all the factors that you can control now. So similarly, in credit risk, we have some external environment and internal environment. Now, external environment is portfolio risk, means overall, and internal environment is transaction risk. Now, in portfolio risk or in overall risk, concentration risk is there when you are giving much large amount of loan to any specific sector, industry risk, and in internal environment, we have different type of risk. Now, concentration risk, that too much loan given to only one specific sector or one borrower, then it will bring your concentration risk. So if that sector fails, if that sector is unable to pay you the money, then you will be having a lot of loss. Now, industry risk means when the whole industry is facing the risk. If whole market is facing the risk, industry is facing the risk, then borrowers, customers, users, they are related from that industry, so they will also face a risk. Now, internal environment is default risk. So default is when borrower has not repaid the loan on the due date. Then spread risk is what? Now, this is loss due to change in difference between interest rate. Suppose, okay, margin requirements. Now, suppose the borrower has given you the collateral and you have kept 20% of the margin requirement. But now, spontaneously, the value of those assets decreased. Okay, decreased. Now, what bank will do? Bank, they want to safeguard their measures. Okay, they want to protect their loan. They want to recover their loan as soon as possible. So, bank will try to increase the margin requirement. So, this is what? This is the loss that a bank faces when there is difference between interest rate. Or the value of the loan suddenly increased. So, bank will decrease the margin requirement. So, this is depending upon the market fluctuations. Now, downgraded risk is what? Downgrade means when the borrower's credit rating has dropped down. When there's a drop down in the credit rating of the borrower. So, the risk chance of risk will increase. And recovery risk means where the bank has assumed that we will recover our dues, okay, from NPA is still the in doubtful category. There is chance that we will recover our dues, but bank may not get full amount after a loan goes bad. That is recovery risk. So these are different types of risk. Now, so we have some internal and external credit ratings. So in domestically, you have CARE, CRISIL, so all the uh, India Ratings and Research Private Limited, ICRA, Brickwork, okay, Equid Ratings, Infomerics. So these are domestically credit rating that will tell about the borrower's company borrower's history. That is the borrower healthy to disburse loan or not. And internationally, we have Fitch, Moody's, Standard, and Poor. So this is important. and all the full forms are also important. Now, credit information companies. So, credit information companies are what? Now, these are those companies which provide information related to credit. Now, credit of what? The borrower's company. So, such type of companies will provide all the information related to borrower's company to the bank. So that bank, they may get aware before disbursing the loan. So all about credit related information about individuals or business. So these are organizations that will collect it, that will maintain and provide credit related information to the lenders. Lender is what? The bank. To assess the credit worthiness of borrowers, and these companies, they gather data from various lenders about the borrower's credit history, including the loans, the credit card payment and repayment pattern, so that the lenders, they may get aware before disbursing loans. Now, so credit information companies, so they also play a critical role in assessing credit worthiness, enabling lenders, financial institutions, and stakeholders so that they can make informed decisions related to credit. Credit means loan. Now, so global credit information companies, we have Experian, Equifax, TransUnion, and in India we have CIBIL, that is Credit Information Bureau of India, Equifax Credit Information Services, Experian Indian. So these are all the Indian CICs. As of now, there are 4 credit information companies in India. Now, so CIBIL is what? It is India's first CIC offering credit reports. Now, this is the subsidiary. Equifax Credit Information Services is what? It is the subsidiary of Equifax. It also provides credit related information. This slide is very important. Now, so Credit Information Bureau, that is CIBIL, it was set up by whom? State Bank of India. In association with which bank? HDFC Bank in year 2001. At present, there are 4 CICs. So initially, when the companies are allowed to work as CIC, so there were only 3 CICs, and 3 other companies are also permitted to work as CICs. But now there are total 4 CICs in India. Now, so name of the CIBIL, it has been changed to TransUnion CIBIL Limited. The name has been changed. And on January 2015, RBI has directed to all the credit institutions that they can become members of credit information companies, and they have to submit all the data to CICs. And all the CIC and CIs shall keep the credit information collected, maintained by them on monthly basis. So information should be collected and it should be updated on a monthly basis. Now, all the banks, financial institutions, they will submit the list of SU filed accounts, means those accounts which are already the filed is being, okay, the claim is there, and non-SU filed accounts. So both the accounts of willful defaulter. Now, who are willful defaulters? These are those defaulters who have not paid your money intentionally. The borrower is having the money, the borrower is having a huge amount, but still the borrower is unable to repay your money. Borrower is not paying you the money intentionally. So that is known as willful defaulters. So if the accounts of willful defaulter is rupees 25 lakh and above on a monthly, then all the information has to be provided to 4 CICs related to SU filed account, non-SU filed account. Those accounts which have been already filed and those accounts which have been not filed yet. And the limit is, that is 25 lakh and above on a monthly basis. Now, so 4 CICs in India are TransUnion CIBIL Limited, then Equifax Credit Information, Experian Credit Information Private Limited, and CRIF High Mark Credit Information Private Limited. So these are all 4 CICs in working in India. Now, there is one term that is called CRILC. Okay, so see, what is CRILC? Basically, when the huge amount of loan has been sanctioned and when the banks are unable to recover their amount, so either it is a fund-based amount or non-fund-based amount. So if any person or any company has total loan amount of 5 crore or more, so bank will provide all the report, all the details to whom? To CRILC. So CRILC It is a system created by RBI to collect and share information about big loans. Big loans means 5 crore, it is 5 crore or more. So that is the amount, big amount. Now, why banks will report to CRILC large credit information? Because amount is very high and all the details have to be submitted to whom? CRILC. This includes even if the loan is not being paid on time, even the banks are preparing the SMA account, special mention account. Now, what are the three categories of SMA? Tell me quickly, those who are watching. Three categories of SMA. That is SMA 0, SMA 1, and SMA 2. Now, 0 is what? That is 1 to 30 days, 31 to 60 days, and SMA 2 61 to 90 days. Okay, now, so even if the loan is not paid on time and banks are making the SMA, still the information has to be provided to whom? That is CRILC. Now, what is CRILC? Full form is also important. Central Repository of Information on Large Credits. Now, so the when the reports are provided to CRILC, so there are certain exemptions. Means what is not reported. So crop loans are not reported, and banks who have taken the interbank loans are also not reported. So banks do not need to report loans when they have given loans to other bank like Nabard, SEBI, Exim, and NHB. Okay, so these are the two things. These are the two components that are not included in CRILC. Rest every type of reporting is being included in it. So other agricultural loan these are included, but crop loans are not included. And full form is important. All right. So we have completed unit number 23. Yes, correct. It's 012. Now next is restructuring, rehabilitation, and recovery. Now see, bank has used different methods to recover its amount. Bank has made provisions also. Now, so bank, if the borrower is not repaying the money, borrower is unable to pay his or her dues, then bank will use three courses of action. Now, what are these three courses of action? Restructuring or rehabilitation. Restructuring, rehabilitation one. Second is rectification, and third is recovery. So rectification, restructuring, and recovery. So these are the three courses of action that bank will take help so that bank can recover its dues from borrower. Now, so for this, for using all these three courses of action, the default should happen. Then only when there is default, then only you will use these three courses of action. Now, so what is credit default? Credit default means when there is inability or unwillingness of a customer to meet their commitment in relation to lending. Means simple language, when borrower has not repaid its money, when borrower is not in a position to repay all their dues to the bank, then the default is done, and that type of default is known as credit default. Now, so in case of direct lending, if principal plus interest amount is not repaid in terms of the structuring, in terms of the date decided, that is called credit default. When in case of guarantees, the banks when they have issued LC and the amount is not paid, then credit default is there. In case of treasury operations, the amount is not paid, that is credit default. So if you will see, when the dues are not paid on time, so in all the cases the default is done, and that is called credit default. So either it is in cross border transactions, in international transactions, or in domestic transactions when settlement is not there. Module A, it's being covered in paid classes, and Ajay sir is taking module A. I'm taking only three modules B, C, and D. So right now he's taking classes on paid, and I'm on YouTube. All right. Now, next is what? Next is a provisioning coverage ratio. In short, it is known as PCR. Now, what is provisioning coverage ratio? See, every bank they make some provisions, okay, depending upon the loan. So at least they always get a hint after disbursing the loans or when they have not recovered their dues. So bank will start making provisions for that. Now, provision means keeping money aside. Keeping money aside. That is what the provision is. Now, so bank should build a provisioning buffers. Buffers means the extra amount that bank will keep aside so that bank can recover at least some of the amount from absorbing losses. Now, suppose let's take an example. Bank portfolio is uh, let's take it 500 crore. Okay, now this is the portfolio of bank. Now, and portfolio means the overall amount that bank will sanction, bank will disburse to all the borrowers. And from this portfolio, what is the chance of the NP? NP, the let's take it. NP is 50 crore. Now, 500 crore is the bank portfolio. NP is 50 crore. And what provisions bank has made? Bank has made the provision of 5 crore. So this is just we have assumed it. Now, if bank has made the provision of 5 crore, NP is 50 crore. Now, what is provisioning coverage ratio? How to calculate provisioning coverage ratio? So there is one formula. So it is provisions for NPA upon total gross NPA into 100. So this is what? This is the formula of provisioning coverage ratio. Now, what are the provisions for NPA? Provision NPA has made the provision of 5 crore. Total gross NPA. Gross NPA is how much? 50 crore into 100. That is 10%. It means from its 5 crore, 500 crore portfolio, bank has made how much provision? 10% provision. It means PCR is what? That is 10% of 500 crore. So that is known as provisioning coverage ratio, the extra amount which you are keeping aside so that you can absorb losses, you can cover your, uh, you can say, few have some amount. All right. So this is PCR. Now, next we have the topic that is willful defaulters. Now, who are willful defaulters? See, I told you that if the person is having money, but still person means borrower, but still that borrower is not repaying the dues to the bank. Means the deliberate action is there. Intentionally, the borrower is not repaying the dues to the bank. So that is known as willful defaulters. So when in willful defaulters, two words are important. That is deliberate and intentional. So deliberate action should be there, intention should be there. Then only that borrower will be termed as willful defaulter. If there is any genuine reason borrower is unable to repay the dues, that borrower will never be counted as willful defaulter. But if there is not any genuine reason, borrower is intentionally not paying the dues, so that is willful default. Now, the default in payment as per agreed terms could be intentional. See, the word is written intentional or due to the reason beyond the control of borrower. If intention is there, then willful defaulter. If beyond the control of borrower is there, no willful defaulter. Means something has happened which is beyond my control. I cannot control that. So it doesn't mean that I am a willful defaulter. So intentional default is referred as willful default and beyond the control of borrower is not referred as willful default. Now, so what are the elements that are included? What are the following events that is being done to set as willful defaulter? Now, so everywhere if you will see it is written unit has defaulted. Unit has defaulted. Now, unit means the borrower has defaulted. The person has defaulted. Means meeting its payment or repayment obligation due to do the obligations to the lender even when it has the capacity. When the borrower has the capacity, still borrower is not repaying the obligation, that is willful defaulter. Now, or when the borrower has defaulted in meeting its payment, repayment obligation to the lender, has not utilized the finance borrowed for the specific purpose. Means borrower has taken the loan in the name of working capital finance. And now this borrower is using this money, uh, let's take it for long-term finance for any infrastructure project. Means for what purpose you have taken the money, you are not using in that purpose, you are using in some different purpose, but you are using it any legal purpose, so that is so known as willful default. Has diverted the funds. Diverted, now there is one word known as diversion and siphoning. Okay, siphoning, not symphony, siphoning. So these are the two terms that are very, very important. We'll do in next slide. Again, unit has defaulted means not utilized for the specific purpose for which the finance was available for. It was used for some other purpose. And when the borrower has disposed of all its asset. Suppose, let's take an example. Borrower has taken the loan and borrower has given the paper of its car, the car documents. Now, and borrower has done a very cleverness. Borrower has disposed of this car. Already this car was given as a security to the bank and borrower has disposed this car. It means now the borrower has disposed without the knowledge to the lender. The lender is having no any kind of knowledge that the security has been disposed of. So this will also come under willful default. Borrower has also disposed of or removed the movable fixed assets or immovable property given him for as security, as securing a term loan without the knowledge of bank. So it will be also said as a willful default. Now, next is what that is diversion and siphoning of funds. Now, diversion and siphoning means diversion is still acceptable. Diversion is still acceptable, but siphoning is not acceptable. Now, diversion means you have diverted the funds, you have used that funds in some other purpose. Now, what are the points that are included in diversion of funds? Utilization of short working capital funds when you have taken it for long term purpose or vice versa. Or you have borrowed funds for purpose of creation of assets other than those for which the loan was sanctioned. You have taken the loan in the name of some other thing and you have used for purchasing any other assets. That transferring borrowed funds to the subsidiary. You have taken loan in the name of your company and you have transferred that money to your subsidiary company or your group company. That will be said as that will be counted as diversion of funds. Now, routing of funds through any bank, any other lender, like you have taken the loan from XYZ bank and without the knowledge of XYZ bank, you have taken the loan from any other bank, like consortium loan or loan syndication. So this will also considered as diversion of funds. Or you have invested in any other company, you have purchased the shares of any other company, equity of any other company without the approval of lenders, that will be considered as diversion of fund. And if there is shortfall in deployment of funds, shortfall means suppose okay, suppose you have purchased the machinery of worth rupees 20 lakh, but you have written in your statements it is the costing is of 25 lakh. Now, where is that 5 lakh rupees? 5 lakh is not matching. So the difference that not being accounted for. So this will also be considered as diversion of funds. So these are all the points under diversion of funds. Now, let's move to the next, that is siphoning of funds. Now, siphoning of funds means when you are using the funds for any illegal activity, for your personal purpose, in betting, then speculation. So that is said as siphoning of funds. So it is not acceptable. So it happens when borrower takes a loan from a bank or financial institution but uses the money for something else, and that too in illegal purpose. Now, it misuse the harm of the borrower's own money, and it can also cause loss to the lender. Suppose a company takes a loan to build a factory, but instead using that money to build a factory, the borrower has used that money to buy its personal property, like a car or any other vehicle or any other thing. So that is known as stiffening of funds. And when borrower and lender will decide based on the proof, based on the fact that no, this is not diversion of funds, this is stiffening of funds. So based on the judgment, so that will be considered as stiffening of funds. So borrower misuses loan money used for any illegal purpose, and with that, the bank is also suffering loss, and the borrower it also causes harm. So that is called stiffening of funds. I hope the clear diversion and stiffening of funds. Now, next is non-cooperative borrower. Now, break all the words. Borrower means the one who has borrowed money. Now, non-cooperative means and the one who is not cooperating, who is not helping, means such borrowers who are not helping to the bank so that bank can recover its dues. Now, in this, two things are happening. First is borrower has not given loan, borrower has not repaid loan. This is the first thing, the mistake done by the borrower. And second thing, when the bank is using different courses of action, when the bank itself tries to restructure the loan scenario or tries to rectify the borrower's mistake, but still that borrower is not helping the bank, or when bank is trying to have the access all the or the records of the borrower's company, and still that borrower is not giving any kind of information to the bank, so that is a non-cooperative borrower. Means borrower is standing like a wall between his company and between bank. All right, so that is called non-cooperative borrower. Now, next is if bank, financial institutions, they have to follow certain measures. When to classify that borrower is a you can say borrower is a cooperative borrower and borrower is a non-cooperative borrower. When to classify? So for that, different scenario is created. The different rules are made, and all the information should be submitted to whom? CAIIB. Now, full form I have already told you, that is Central Repository of Information on Large Credits. Now, what is the amount of large credits? How we know, how we can say that these are large credits or small credits? When either the fund-based transaction or from non-fund-based transaction, when any borrower has taken the loan worth rupees 5 crore and more and not repaid to the bank, then that will be considered as what loan. All the reports should have to be submitted to CAIIB. So this is the cutoff limit for classifying borrowers as non-cooperative would be those borrowers having aggregate fund. Fund-based means when there is actual transfer of money from bank account to borrower account. Non-fund-based, right now immediate transfer is not there, but in future transfer may happen. That is non-fund-based. So if the limit is 5 crore or more than that, then that borrower is said as non-cooperative borrower, and all the information should be provided to whom? CAIIB. So reporting information should be provided to CAIIB. So if a company is not cooperating with the bank, for example, what company can do? Company can hide information. Company is not repaying the loan. Company is refusing to share financial details. Company or borrower. So that will be said as non-cooperative borrower. Now, and the label of non-cooperative, it is not just for the company. It also includes when promoters are there, when directors are also there. So promoters and directors, they will also be considered over here as non-cooperative. But in this non-cooperative, who are the two persons that are not included? Independent directors, those take their own dependent, you can say they are neutral. Okay, they are not directly related to the company. They are not directly involved in daily operations. They independent take their own decisions. Independent directors and nominee directors, the who are sent by the government or bank. Means bank nominees. We have seen in project appraisal that bank should not depend on the certificates issued by CEO of that company to whom the bank is giving loan. So rather, bank should appoint one nominee in that company so that that bank's nominee can check all the details of the company, all the compliances, all the audit, internal checks, investigation, internal control, everything. So the nominee directors will not be included in non-cooperative. Now, so what are the process for declaring a borrower as non-cooperative? So first, committee will make the decision. Okay, committee will check all the fact of the borrower's company, and if they conclude that borrower is indeed a non-cooperative, they do not declare it immediately. It will more details would be checked related to borrower. So borrower would be given chance to defend himself or herself that you are non-cooperative or you are cooperative. Next is show cause notice will be provided. So committee will send a show cause notice to the borrower. And in case when the company is having its promoters and directors, so company will send the notice to promoters and directors also. These two, promoters and directors. Then the committee will give the chance to the borrower, to the company to explain or defend themselves that, okay, if you have not done any mistake, if you are not a non-cooperative borrower, then you have to prove it yourself. So they send a written reply and explain why they should not be declared as non-cooperative. After that, once the borrower has written, once the borrower has submitted to defend itself the written document, then opportunity will be there for hearing. So if committee will feel that yes, the borrower has given all the explanation and those explanation are genuine, then committee will conduct one-to-one meeting in which face-to-face they will ask from the borrower. Face-to-face or virtual meeting will be there. And at last, after having a meeting, after conducting a meeting with the borrower, then the final order will be made, whether the borrower is cooperative or non-cooperative. So the order will officially declare the borrower as non-cooperative if the borrower is. Done? All right. Now, next is okay, so this was A, then it is B. Now, next is again the order of the committee should be reviewed. See, it's not that only one committee has given the order, then it is finally said that this borrower is non-cooperative. No, the order of committee will be reviewed by another committee, and that committee who, if the chairman is MD, if CEO is the chairman, and in addition to that, two independent directors of the bank will also submit the final order. They will also the final call would be of independent directors and other committee. If they will confirm that yes, this review committee has given properly all the orders, it is all checked, everything is good, then only the order will be, then only that final implementation will be there. Now, so banks, financial institutions will require to report information on non-cooperative borrowers in how many days? To CRILIC within 21 days. So information will be provided to CRILIC by banks and financial institution within 21 days when they have justified that yes, this is a non-cooperative borrower. Now, it may happen that okay, right now I'm not supporting. Right now I have become a non-cooperative borrower, but after some time I have accepted my mistake. Now I want to become a cooperative borrower. So how can I become a cooperative borrower again? So in that case, D classification would be there. So if borrower becomes cooperative, again banks should review the status every 6 months. The bank will check in half yearly that yes, is this borrower now a cooperative borrower? If yes, then bank will remove the word non word from its cooperative list. So if removed, the bank must report all the reasons to the CRILIC. And impact on new loans, it's not that bank will set freely that yes, okay, now this borrower is a cooperative. No, bank will check all the activities of this borrower in every few months. If any new loans to is being provided or companies with their directors on the board will carry higher risk. So that is why bank will always check in regular interval. That is all about the non-cooperative borrowers. Done. Now, again, one request from you all, if you are new to this channel, do subscribe this channel because your exam will start from 30th of November. After that, you have your second paper BFM, then again third paper ABFM. So I'll take the class, then BRBL, then elective paper. So every day you will be seeing a daily new content in this channel. So that is why please keep subscribing channel everybody. And if you feel sessions are helpful, no matter whose session is that, if you feel sessions are helpful, then please please like the session. Now, next is what that is three courses of action. So I told you that banks will provide three courses of action: rectification, restructuring, and recovery. Now, rectification means what? Bank will give the chance to the borrower that rectify its mistake. So bank will give chance to correct the mistake, and from after correcting, regular your loan means regularize your loan, or bank will take the exit mode. Now, restructuring means bank will restructure. Re means re plus structure. Re means again, and structure means that the changing the pattern of loan, changing the interest rate, giving more time, okay, giving some grace period, that is restructuring, or some additional finance. And at last, bank will take the help of legal action, okay, SARFAESI Act, then DRT, so all these things, and IBC. Now, rectification means regularization. So, it is to encourage borrower to pay overdue amount and ensure that the borrower should stay on their uh, whatever the borrower has said and repay on time in the future. So, bank will provide a rectification method to borrow that okay, you have not given your loan since 3 months or 4 months. So now pay all your loan of your 3 months, 4 months, and from here onwards regularize your all dues. That is rectification. Or when bank is seeing that a bank has uh, bank has seen the early sign signals of borrower that this borrower is not healthy enough. Okay, we have provided loans to the wrong borrower. So in that case, bank can take the exit mode. So bank's first priority is to take exit from accounts when it shows early signs of financial stress. If the signs are identified early, so bank will shift the borrower to some other account. And if another bank is willing to take that loan, so bank will offer them. If signs of stress become more obvious, then it is difficult for other banks also to provide loan to this borrower. Now, in case of consortium and multiple banking, if banks are having any kind of risk, they are seeing any kind of risk, they can take it exit mode, and rest of the other banks, they will share the risk. But in case of sole banking, then it is very challenging for the bank to take the exit. So in that case, bank will have to uh, provide different more measures so that the borrower can recover their dues. Now, next is restructuring. So, if bank sees that default is not willful, it's a genuine reason. Okay, bank company is unable to repay its dues because company this year the company has suffered a lot of loss. Might be could any reason. It could be the reason of strategic failure. It could be the reason of not capital adequacy the company is having. So, company the reasons are genuine. So, bank will give the restructure method. Now, what is restructure? That is, bank will give some concession to the borrower. The bank will grant to the borrower's concession that okay, your the interest was at the rate of 10%. Now I'm providing you interest. I have reduced the interest from 10 to 8%. Now you have to repay my loan at the rate of 8%. Or concessions will include the elongation period, fresh moratorium period, repayment period is increased. Okay, I'm giving you some more time, 2 months extra, 6 months extra, or even I will give you extra finance that do your work. Okay, make revenue from this money, and once your business the growth is high, once you have made a huge profit, then repay my all money back. So that is what the bank will provide the option, the elongation period and bank finance. Now, next, third is what that is recovery. When from these two, still the bank is unable to recover its dues, so bank will take the help of recovery. So how bank will recover their amount? With civil court. So is there for recovery of bank dues, it is filed before civil court when the borrower has taken less than 20 lakh rupees. So if it is in the favor of bank, that yes, borrower has to provide loans to the bank, and banks, they are not unable to recover their dues. So a preliminary decree is provided. So this decree says that the borrower will have to repay all the amount within 6 months. And if the amount is not paid in that 6 months, then bank will apply for the final decree. And in that final decree is what is the time period? So bank can recover its dues up to a period of 12 years. So now the limitation period for final decree is 12 years. And in that, the recovery needs to be complete. Now, DRT, Debt Recovery Tribunals, so it is created for financial institutions where the recovery cases amount is 20 lakh and above. So it is below 20 lakh, it is above 20 lakh. And NBFCs are also included under DRT now. So if those NBFCs whose asset size is more than 100 crore, so they can also file case in Debt Recovery Tribunal. Similarly, Lok Adalats, so it is when the dues is up to 20 lakh. So one can take the help of civil judiciary. And that is last is insolvency bankruptcy court. So we have separate chapter for this. So we'll discuss in next chapter. Now, one is left, that is SARFAESI Act. So full form is very important. Okay. In 2 times the full form was asked in the exam. When this act came in the year 2002, securitization and reconstruction of financial assets and enforcement of security interest. Now, when banks, they don't want to go to court, without going to court, if they want to recover money, then they can take the help of this act. That is SARFAESI Act. Now, what does this act provide? This act basically gives the possession of the property. Like if borrower has not repaid a loan, the bank can take possession of the property and bank can sell that property. So before selling the property, bank will provide the notice to the borrower. That 60 days notice is provided. Okay, you have not recovered your money. Now I'm going to sell your assets within 60 days, within 2 months. So in 2 months, either you can come and recover all your dues, or else I'll sell your property. And if borrower doesn't repay within that 60 days notice, then borrower can go ahead. Bank can go ahead. Now, so to whom bank will sell all the assets? So bank will sell all their bad loans to securitization companies or reconstruction companies to recover the money. And if bank wants to fulfill all these things within a limited time, okay, in bank needs a faster process, then bank can go DRT. Because DRT will have to provide decision within 60 days. And here bank will have to wait for 60 days. And then after that, bank will take any action. So this is for quick recovery and this is for recovery without the intervention of court. Now, next is if any MSME is there, now how to do restructuring to those MSME. So if any micro, small and medium enterprise has taken loan from bank, okay, up to a limit of 25 crore, bank loans up to 25 crore. If stressed MSME is there, now what are the different things that are related to MSME? So if a stressed MSME has the loan limit above 10 lakh, so branch or CPC will handle all the accounts. And after handling, the CPC will send it to a designated committee for making a resolution plan. And when it will send, the CPC will send within 5 days based on EWS early warning signals, and recovery option is provided in resolution plan. Now, if the bank is filing an application and committee has company has reviewed all the application and committee accept that application, then after accepting, the borrower would be provided a notification. So borrower will be notified within 5 working days. And after 5 working days, when borrower has given the notification that we will make a resolution plan for your company, okay, you have to provide all the details. So borrower will make a respond to a representation within 15 working days. So committee will provide after accepting, the bank will provide the application, and committee, when the committee has accepted, then committee will provide the information to the borrower within 5 working days. And once the borrower has received that notification, that document, that application, okay, after that borrower will respond it within 15 days. And within 15 days, borrower will have to respond after receiving the notice. Now, and if RP is finalized, RP means resolution plan is finalized. Now, if the resolution plan is involving rectification, it is implemented in 30 days. If the plan involves restructuring, it is implemented in 90 days. And if recovery is there, it is implemented in 30 days. Now, how to learn this? See, in rectification, we have C. In recovery also, we have C. Now, and C is what? C is the third letter of alphabet. Now, C is the third letter of alphabet. So add 0, that is 30. So rectification 30 days, recovery 30 days. Now, what is left, restructuring is left. So that is 90 days. So third letter of alphabet C and third. So add 0. So in this way, you can remember the rectification. It should be implemented in 30 days. Recovery 30 days, and what is left, that is restructuring in 90 days. Now, next is framework for resolution of all the stressed assets. Now, what is the framework for a resolution of the stressed assets? See, all lenders have must put in place board approved policies for resolution of stressed assets, including the timelines for resolution. Now, once a borrower is reported to be in default by any of the lender, so lenders shall undertake a prima facie review of the borrower account within 30 days, and from 30 days from such default, that is known as the review period. Now, so during this review period of 30 days, lender will decide the strategy, okay, the resolution plan, including the nature of resolution plan, the approach for implementation of that resolution plan. Lenders will choose to initiate all the legal proceedings for insolvency, for recovery of dues. So in review period, that is 30 days. Now, and after that, the resolution plan, uh, it is a resolution plan should be implemented, and it is implemented within 180 days from the end of review period. Now, so see, every bank must have its own plan. So bank will prepare a board approved policy on how they will handle stress loans, including steps and timelines. And the moment even one bank or lender says the borrower has defaulted, so all lenders must start a review period of 30 days. Now, what is happening during this 30-day review period? So, lenders will check the borrower situation. Lenders will decide how much they want to solve the problem, how they want to solve the problem, choose the resolution plan, restructuring, new terms, recovery. They may also start a legal action if needed, like insolvency. And after the review period ends, the final resolution plan must be fully implemented within 180 days. Now, so review period 30 days, implementation 180 days. So total how much it is? 210 days maximum it is provided. But you have to remember it separately. That is 30 days a review period, and 30 days review period, and 180 days the implementation of resolution plan. Now, so implementation condition for RP is what? See, uh, when banks they want to restructure a big stressed loan, or if they want to change the ownership of the borrower, so RBI has made some of the guidelines that all these need to be checked. The resolution plan need to be submitted and checked by an independent credit rating agencies. Now, so if the exposure is equal to greater than 100 crore, the resolution plan must be checked by ICE, independent credit evaluation. Now, if it is 100 crore to 499, one ICE is needed, one independent credit evaluation is needed. But if the amount is exposure is more than 500 crore and above, then two ICEs are needed. Now, and for that, the resolution plan, it will be accepted only if the remaining debt gets a rating of RP4 or better. Now, resolution plan is what? The plan made to recover all the dues. How we can help borrower uh, so that borrower can recover all their dues. So it is only accepted when the remaining amount is there. Means after providing restructuring, after providing rectification method, whatever amount is left, if that amount gets a rating of RP4 or better, then that in that the resolution plan will be accepted. Otherwise, not. Now, what is RP4 or better? So it is resolution plan 4 or better. See, RP1 is best, then second best RP2, third best RP3, 4 is minimal acceptable grade. Like in grading system, we say na A, B, C, D, E. A is best, B is okay, C is average, D is below average, and E is fail. Now, so till C it is acceptable. After D below average means it is not acceptable for uh, not any parent or any teacher will going to accept it if you are getting a D grade. So similar to this, RP4 is the minimum acceptable grade. After that, it is not acceptable means you can assume it is a failed. So RP must be rated 4, RP4 or higher. Now RP4 or higher means what? It does not mean RP5. Higher means either RP3, either RP2 or RP1. Means higher is over here, na? It is going from decreasing order. So best, second best, third best, fourth best, and fifth is not acceptable. So RP is rated RP4 or higher means either 3, 2, 1. Now, next topic is all about DCCO, that is date of commencement of commercial operation. Now, see what happens. This is basically from when onwards you are starting your operation, you are starting your work, commencement of work. And if you will start your work, if you will start your operations, from that time only you will going to make a profit. So DCCO is what? Date of commencement of commercial operation. So planned date on which a project is supposed to start working and earning money. Like if you have a if you have make a thought in your mind that okay, we will it's 2025. Now I have taken a loan for 10 years for infrastructure project. So I should start making money from 2035 onwards. Now, so this is the DCCO. The planned date on which a project is supposed to start. But due to any problems, okay, the personal issues, the technical issues, any professional issues, now this has been stopped. Now the commencement has been started from 2038 after 3 years. So what is if there is any shift in the DCCO, then what would be the impact? So general rule, what it says that if the project gets delayed and the DCCO is shifted, then loan is treated as restructured. The bank will give the restructuring method. So it is assumed as restructured and the accounts become substandard. And if it is a restructured means the bank has given the money for that after 10 years you will make your business, you will start doing your business and whatever profits will come, you will repay your bank. So now if it is delayed, then bank will also have to wait for few years that when you are start making your profit, then only you will provide the money, you will repay the money to bank. So this is now bad for bank. But in this, RBI gives some relaxation. What RBI says that if there is any delay in DCCO, it will not be treated as restructuring when two conditions are met. Now, what are those two conditions? Condition one, delay limit. If limit is delayed, means 2 years extra is provided for infrastructure project, and if any borrower has taken loan for any non-infrastructure project, then 1 year extra is given. Counted from original DCCO, like 2035 is the original DCCO. So counted from this. 2 years means 24 months and here 12 months. Now, condition two, that only the date will be shifted. No other changes is there. It's not that the bank will charge you high rate of interest or bank will give you some relaxation. You can say the concession on the interest rate or bank will help you, so give you double finance. No, it's not that. Only date is shifted. Other all other things would be same. Like example is our infrastructure project is there, was supposed to start working on. Now, original DCCO was 1st Jan 2025. And due to the construction got delayed, so project will now start on 1st Jan 2026. Now, revised DCCO is 1st November 2026. So what is the gap? Gap delay of 22 months are there. Now, is this considered a restructuring? No. Why no? Because relaxation is provided for 2 years. So in 2 years, we have 24 months and this is only 22 months. So this will not be considered as restructuring. Infrastructure project delay up to 24 months, but here it is allowed, it is only 22 months. So 24 months are allowed without classifying the loans as restructuring. So relaxation is provided up to 2 years, 24 months. Now, so this is the deferment. Now, first deferment for infrastructure project is 2 years given, non-infrastructure 1. Now, T is what? T was the actual time of DCCO. All right. Now, if any deferment is there due to the reasons beyond the control of promoter, means the promoter cannot control, like natural calamities are there. In when the for infrastructure in doing the construction work, there is a like a flood came. So this is not in the control of the promoter. It is just by the due to natural calamities. So 2 years already there, and now 1 year more is given in infrastructure. But in non-infrastructure, it is 1 year also given. So in both the 1 year is provided. So now it becomes T plus 3, it is T plus 2. Now, if the code, if there is deferment due to the court case, then again 1 more year is given and it is same. Deferment when the owner is changed, when the infrastructure project, those who the tender was given and the one who has decided to make this construction work, if that person is changed, so total 6 years are provided. For infrastructure, non-infrastructure, 4 years. All right, done. So this was now. So this already I have added in yesterday's slide. So I thought that till yesterday we will complete till here. Chalo. So let's start our next slide. Just a minute. Okay, so let's start unit number 25. Now, so unit number 25 is all about IBC 2016. So Insolvency and Bankruptcy Code 2016. Now, when bank has provided three courses of action, now the borrower is unable to repay the money to the bank after getting three courses of action. So what is the last step the bank can use? That is, bank can take the help of Insolvency Bankruptcy Code 2016. Now, this is why the code is written, why not act is. So this is not any act. Why? Because many different laws are being compiled in this in IBC. That is why no act is there, it's a law. Now, so what does it say? It says that if any bank wants to file the case related to any company, so they can file the case to NCLT. Application would be provided to NCLT. When NCLT will review all the applications, after that the CIRP process will start. Now, those who are watching this for the very first time, what is CIRP, what is PIRP, you won't understand. So I hope you all have studied in your different batches what is PIRP, what is CIRP. Now, no, it's very less time is there to explain each and every topic. All right. Now, CIRP is initiated. Now, after when the CIRP is initiated, then the resolution plan is made. Committee of creditors will approve the resolution plan. After committee of creditor has approved, then the resolution plan would be provided to NCLT. When NCLT has said that yes, now we can implement this plan, now the final plan would be implemented, and This IBC code mainly helps the stressed companies, the stressed borrowers, so that they can recover the amount and those companies would become again a good company so that they can do their operations, they can make profit again. See, and if not, the company is not still not repaying the loan with CIRP or PIRP process. If resolution plan is not good, then last option, what is left, that is liquidation of company, winding of the company. So, what the liquidation value? What would be the value of all the assets? Okay, how much liquidation amount is there, and that amount will be distributed to all among creditors. So that is what this is IBC 2016. Now, so in there it is two terms. So all the terms, dates, limits, all these are important in this chapter. Now, what is insolvency and bankruptcy? Now, insolvency means, see, every company now in India, most of the companies they are having liabilities greater and assets less. Now, still they operate their work. Why? Because if their liabilities are greater, they will make money, they will make profit. After that, they will pay off their liabilities. Again, they will take working capital, they will take term loans, their liabilities would be high. Again, they will do regular operations in their business, they will make profit, the revenue is generated, they will pay off their liabilities. So most of the companies, 80 to 90% companies, they do their work in this way. Not every company is a healthy company. Not every company you will see that they are having more assets and less liabilities. Majorly companies they are having more liabilities and less assets. But it does not mean that that company is insolvent or bankrupt. So for insolvency and bankruptcy, more things are required. Now, first is liabilities are greater than assets plus unable to pay debt obligation. The company is not in a position to repay all their debt. That is called insolvency. Now, what is bankruptcy? Liabilities are greater than assets plus unable to repay all the loans to pay obligations. And when court gives you the certificate, when court provides you the certificate that this company is now a bankrupt company, then only the company or the institution would be considered as bankrupt. All right, so this is the difference between bankruptcy. So it is a legal recognition of the insolvency, means insolvency is there, and a bankrupt person or entity is a debtor who has been adjudged as bankrupt by whom? By court. Now, adjudicating authority is what? It is a court. When court has given the order of bankrupt, when court has given a certificate of bankrupt, then the bankruptcy is there. Now, so what are the elements, legal elements of this code? So IBBI is what? Like RBI is the apex body for all the banks. So similarly, IBBI is the apex body. IBBI is the regulator of IBC. So in IBBI, IPA would be appointed professional agencies. These agencies, they will appoint professional persons. Those are known as interim resolution professionals, resolution professionals. Now, why these persons are appointed? So that they can conduct the resolution plan. They can make a resolution plan. They can initiate CIRP process. They can initiate PIRP process. Now, information utilities, when the borrower company, now borrower who has done the default, now that would be known as corporate debtor. In IBC code, you will see CD. Now, CD is what? Corporate debtor, the defaulting company. So, if the information is collected of the defaulting company, so that is known as utilities. All the informations are stored in one database related to corporate debtor, that is utilities. Now, creditors are there. Two types of creditors are there: financial, operational. Later on, we will see the difference between these two creditors, who are financial, who are operational. Now, if all the creditors, if they will make a group, that is known as committee of creditor. CD, uh, defaulting company. Now, and these are the judiciary body. NCLT, full form, National Company Law Tribunal. Now, if the bank, if the creditors, they are not satisfied with the decision of NCLT, then they can move towards a high authority that is known as NCLT. Like We have High Court and Supreme Court. If one is not satisfied with the decisions of the High Court, they can go to Supreme Court. So similarly here, if you are not satisfied, if creditors, if banks, institutions, they are not satisfied with NCLT, then they can move towards a highest authority, NCLT. Similarly, DRT and DRAT. If one is not satisfied with the decisions of Debt Recovery Tribunal, can go to Debt Recovery Appellate Tribunal and Supreme Court. Now, so who are professionals? So these are the frontline warriors that will implement the IBC. Implement IBC means initiate the CIRP process. The IBBI will undertake the role of IRP, resolution professional, liquidator. Now, if IRP and RP, interim resolution professional, is there, then second is resolution professional, and sometimes the resolution professional can become the liquidator when resolution plan is not made properly. So last step is what? That is liquidation of the company. So who will do the liquidation work? The liquidator will do. Now we have entities also. So these are the you can say the registered firms, and these entities, they will make professionals who can start the IBC, who can implement IBC or initiate CIRP process. Now, so IBBI is what? It is the regulatory body established under Insolvency Bankruptcy Code. It oversees the insolvency and bankruptcy proceedings in India. Why? To help the stressed nature of companies, to make the company more transparent, for resolving insolvency issues, companies, partnership, and individuals. So, what is the role of IBBI? To improve the ease of doing business, then enhancing the creditors so that the recovery rate is high. So, creditors, they can get their money back, and it provides a legal framework so that those companies who are a distressed nature of companies, they can do their regular work, they can restart their operations, and they can perform all work in an efficient manner. So we have creditors and committee of creditors. So a group of creditor is known as committee of creditors. Now there are two types of creditors: financial and operational. Now who are financial creditors? Like if any borrower has taken loan from any bank, so those creditors who have lent money to the corporate debtor, and in the hope that this corporate debtor will repay the money when the repayment date comes, so that is known as financial creditors. So financial creditors could be any bank, any NBFC, any financial institutions. These are financial creditors. Now who are operational creditors? Suppose okay, I have a Saloni Limited company. Now, I have taken this is the supplier. Okay, let's take it XYZ. This is the person who has supplied goods to me. Now, I told to this supplier that I will repay your money after 6 months. Now, this person has supplied me goods worth rupees 20 lakhs, or let's take it 1 crore. Okay, worth rupees 1 crore. This supplier has supplied goods. But after 6 months, I'm unable to pay money to the supplier. Now, if the supplier has joined the CIRP process, okay, IBC code, supplier has filed the application to NCLT against me. So this is what? This is a type of operational creditor. So are those who have supplied goods or services on credit, or those who have made any kind of advance payment of money to corporate debtor. Now I am what? I am a corporate debtor. Why? Because I have done the default. All right. Now, so each financial creditor, they will get the voting right to the exposure of corporate debtor. Now, see, majorly the financial creditor would be given the voting right, voting power. If financial creditors are not present, then only the operational creditor would be given voting power, otherwise not. Why? Because financial creditors are bank, NBFC. So comparatively, they have provided more money. They have given huge amount as compared to operational creditors, as compared to this XYZ. So that is why voting power is provided to financial creditors. But if financial creditors are not present, then operational creditor can vote against them. So operational creditors, they only have the observatory role in COC, except where there are no financial creditors. So When the financial creditors are present, operational creditor will only give suggestions or advices. But if financial creditors are not present, they will have a voting power. Now, quorum means what? Quorum means minimum number of people that are required in a meeting. Minimum person who are required in a meeting. Like if I say a meeting is to be conducted. Now, how many people are required over there? If I say minimum number of person is five. So this five will become what? Quorum. So this is the minimum people. If four will be there, no meeting is conducted. If five is there, then meeting will be there. So that is quorum. It is 33 by value. Value means the amount, the the creditors amount, and critical matters are passed by COC with 66 majority. So if any voting is given on critical matters, so if 66% of the approval is there, the committees of approval is there, 66% majority, then only that action would be passed. That plan would be passed. Otherwise not. And on routine matters, 51% majority. Now, suppose okay, this XYZ, because the XYZ, the defaulting amount is 1 crore, and now this XYZ has joined the CIRP process. That is okay. After that, if this XYZ thinks that okay, this is a wastage of time, okay, we will not going to recover our money, a single penny. So it's better to withdraw this case now. So if any creditors they are withdrawing their application, so it is done under section 12A, and the person can only withdraw when committee of creditors will do the 90% of the majority of the committees will be there. Then only the person can withdraw the case, otherwise not. So quorum like 33 by value means what? If 100 crore is there, okay, 100 crore amount is there. Now 33 by value means 33 crore. So at least creditors representing how much? 33 crore. Critical matter 66%, so 66 crore of the debt. 51%, 51 crore of the debt if when we have assumed 100 crore. Now, adjudicating authority, I have told you NCLT is there, DRT is there, DRAT, NCLT, NCLT. If NCLT, then not satisfied, then one can go to NCLT. Similarly, in DRT, if one is not satisfied with the decision of DRT, they can move towards DRAT. Now, so CIRP full form is this. Corporate insolvency resolution process. Now, why this CIRP is initiated just to make a resolution plan, and with this resolution plan, every creditor they would be provided money, they would be given money. Now, so first is initiation of corporate insolvency resolution process. Now, one thing very important: who can initiate the CIRP process? Who can implement IBC? When the amount is 1 crore and above. When the defaulting amount is how much? 1 crore and above. So when any bank, when any financial creditor, when any operational creditor has given 1 crore and more than that, the defaulting amount, then only this IBC code is valid. The CIRP process can be initiated. Otherwise not. The defaulting amount should be 1 crore and more than that. Now, this is for CIRP. Now, what is the amount for PIRP? CIRP is for other than MSME. PIRP is only for MSME, micro, small, and medium enterprises. Now, the defaulting amount is up to 1 crore. If the defaulting amount of stressed MSME is greater than 1 crore, then the normal CIRP process would be followed, not PIRP. All right, understood this one? Now, so again, insolvency resolution process can be initiated. It can be initiated by financial creditors, operational creditors, or even the corporate debtor itself can initiate CIRP process. So that is why it is known as creditor in control. Creditor in control, because creditors can initiate this. And the default is rupees 1 crore or more. Now, so IRP, interim resolution proposal, professional, they will suggest the name. Now they will suggest any CA, any CS, any CMA. and that will start the CIRP process. So after starting the CIRP process, moratorium period is provided. Now, what is the moratorium period? That is known as the grace period. So NCLT approves, NCLT says that, okay, I have seen the application. Now we can start the CIRP process. Now, once the CIRP process is started of corporate debtor, now in that period, the moratorium period is provided. Means a grace period is given. Some extra you can say time period is provided. Now, in this moratorium period, no other creditor, no other bank can come and claim for the amount. Why? Because already the CIRP process is started. So, in between this, no any bank or creditor can come and say that no, we also this company has taken money from us also. This company, we want to sell the assets of this company. No. If you want to take your money, then you have to join the CIRP process. So NCLT will declare moratorium from the date of commencement of insolvency till the final completion of that process. In between this, no other company can come and they can take the possession of the assets of the corporate debtor. Now, so appointment of IRP is there. The IRP will be appointed, and if IRP has not suggested any kind of name, no name is provided. In the absence of such proposed name with IBBI, so NCLT will appoint an IRP within 14 days of admission of CIRP. So if no IRP is appointed in between that period, then NCLT itself will appoint within 14 days. Now, after appointment of IRP, interim resolution professional, so IRP will make a public announcement that now we are going to start the CIRP process of this company. So those who want to recover their money, they can join us. They can submit their claims of, they can submit their proof of claims that whether this company has taken loan from you or not. So after checking, then only they will be included in the CIRP process. Now, the public announcement is done within 3 days of appointment. Within 3 days of appointment, the IRP has to make a public announcement of commencement of CIRP. And it is published on the websites of IBBI and also in two newspapers. Now, two newspaper. So one is your regional language newspaper and one is English. Now, all the creditors, they will come, they will submit their claims and proof of claims within 11 days from the date of announcement. Like today date has been announced. Today is 29th November. Today date has been announced. So in between 11 days, within 11 days, so all the creditors will submit their claims. Now, committee of creditors, we have already completed. Withdrawal of CIP process, 90% of the approval is mandatory. Now, next is information memorandum. So what is information memorandum? So all the information of the corporate debtor company. So information of the creditors, information of the financial statement, all the information of assets and liabilities, latest annual statements, audited financial statements for last 2 years, then all types of debt from corporate debtor, who has become the guarantor, when any bank has issued LC. So what uh, when the LC was issued, for what type of goods, okay, to whom that LC was issued, then name of address of members of partners, number of workers and employees who are working in that corporate debtor company, and any other information. So information memorandum means all types of information are collected. Corporate debtors, corporate debtors company, all type of information is collected and stored at one place, so that whenever the committee of creditors, they want to have any access, they want to know anything related to corporate debtor company, they can have that information. Now, so similarly, like information memorandum, we have, okay, we have asset memorandum. Means in information memorandum, all types of information was there. But in asset memorandum, only the information related to asset. So what is the value of asset? Now, either the asset will be sold on standalone basis or under slump sale. Standalone means one asset each. Okay, like each component is sold. Like if I'm saying that okay, chair is sold, then system is sold, then table is sold. So each component are sold. And slump sale means all the assets at one. At once, all the assets are sold. Now, intended manner of sale, how the sale should be done, online, offline, uh, then sorry, mode of sale we can say online, offline. Manner of sale means either full of the assets you will sell, partial assets or full assets. Then what is the expected amount of realization? How much amount you have expected that after realizing these assets you will get, and any other information related to assets. So asset memorandum is all the information related to asset, and this will be included under section 36. So, in accordance, so the liquidator will prepare an asset memorandum in under this IBC within 75 days from the liquidation commencement date. So, when the liquidation process started, after liquidation process within 75 days, okay, the asset memorandum has to be prepared. All right, now then we have the resolution plan. So in resolution plan is what? It is the plan which is made in the insolvency resolution process, and it is submitted by resolution applicants. So all the resolution applicants will submit the resolution plan about the financial distress of the company to the committee of creditors. And if committee of creditors will say yes, this plan is okay, then the plan will be provided to NCLT. When NCLT approves, then only that plan would be implemented. If NCLT says that no, this plan is not good, then again they have to make a resolution plan, or if not, then the last option is to liquidate the company. Okay, so development is there, resolution applicant, that could be any financial institution, any company, any individual will develop the plan. So all the company's debts would be stated, assets would be stated, what is the maximum value, what is the expected realization value, all these things would be developed. Then approval. So plan is then presented to the committee of creditors. After committee of creditors will say that yes, this plan is okay. And for saying yes, at least 66% of the committee of creditors voting is mandatory. So if 66% of the COC will approve, then that plan will be submitted to NCLT. When NCLT gives the final approval, then it is implemented. Now, what are the content of resolution plan? So a good resolution plan typically includes how creditors will be paid, compensated, how what we can do to restore the company's health, how we can make this company more better, and how we can help the company so that company can resume its operation. Now, company is what? The company is corporate debtor. Clear? Now, next is what? Next is the liquidation process. So, last step is what? That is liquidation process. So, if the resolution plan is not uh, healthy enough to implement, then last process is what? Liquidation process. So, initiation of liquidation process. Now, see, when a company, the corporate debtor, is struggling to pay its debt, a process called CIRP is initiated. We have seen. Now, if this process does not work out, the company may go into a liquidation process, which means selling its assets to pay off its all debts. Now, so thus, now why? How this resolution process will get initiated? So it is automatically initiated under the code where if CIRP fails as no resolution plan is received. If the resolution plan is rejected by the major creditors, that is committee of creditors, or if someone is involved and if someone is breaking the rules, deviating from terms of approved, before information memorandum is prepared, committee of creditors had decided to liquidate the company. So if the creditors who are owned at least 66% of the money decide to shut down the company, or corporate data itself contravenes the CIRP. If the corporate data breaks the rules of the CIRP and someone affected by this applies to the court to close the uh, just close the company, to close this process. So in this, the liquidation process will get started. Now, so what is the submission of proof of claims during liquidation? So any person, see how we can know that okay, you are a you you are included in this liquidation process. How to do that? How to provide the how to submit all the proofs of claim? So if any person who is claiming like he's a creditor or an employee against that company, so even if they have submitted a claim earlier during CIRP, but when there is liquidation process, so again that creditor or employee will have to submit its proof of claim. Now, how to submit? So, financial creditors like banks must submit their claim electronically, and other claimants means financial, apart from financial creditors, operational creditors will submit either by visiting there by post or by electronic means. Now, so difference between financial and operational creditor. Financial means a person who has lent money to the company. It could be any bank, NBFC, and a person who has supplied goods or services. Now, what is the nature of debt? It involves loan or financial transaction. It involves only trade because these are the creditors who only supply goods to the corporate debtor. So any vendor, seller, suppliers, landlords. Now, evidence is what loan agreement, financial contracts, and here is what the receipts, the invoices, the bills of exchange, the promissory note. Voting in COC, yes, financial creditor has given the voting right. Operational creditors are not given voting right unless and until there is no financial creditor available. Now, filing of CIRP, it is included in section 7 and it is included in section 9. Proof of claim, financial creditors will have to submit electronically, the same which we have done, or here with these. Now, so financial creditors can be secured also, means security is provided, and unsecured also. And operational creditors, these are unsecured always. Now, next we have what that is stakeholders listing. These are what? These are the two creditors, the financial and operational. Now, so these two creditors, when they will form group, so these creditors will only known as committee of creditors. So these are only the financial and operational creditors. That is committee of creditors. So the voting right, all the claims, everything will be decided by financial or operational creditor. And voting power is only provided to financial creditor. If financial creditor is not available, then operational creditor would be provided voting right, otherwise not. Now, next we have stakeholders list. Now, what is stakeholders list? See, it is the list of people, the list of people or groups are called stakeholders list. So, who have a claim against the company and it must be submitted within 45 days after the deadline for claims. From the last date of receiving deadline for claims. Now, what this list will involve? List is open for inspection, available for inspection by anyone who can submit the claim, available for inspection to members, partners, directors, guarantors of the company. Then it is displayed on the company's website, uploaded on the official board's website for public access. For dissemination means for distribution of information. Now, what is stakeholders consultation committee? So the liquidator, the person managing the company's disclosure, must form a committee of stakeholders within 60 days. And this committee helps the liquidator by giving advices on that hiring professionals, appointment of professionals, deciding their remuneration, their fees, managing the sale of company's asset, including how the sale will happen, who can bid, what is the reserve price, the minimum price, how to promote the sale, marketing strategy. So these are decided by consultation committee. All right. Now, next is the class of stakeholders. Now, what is this class of stakeholders? So, just now we have seen that there are two types of financial creditors. Now, secured and unsecured. Secured means the security is provided to these creditors. and no security is given. Now, if the financial creditors, if they have given away their security, relinquished their security means given away their security under section 52. So they are, in that case, if the claim of such creditor admitted during liquidation process, if it is less than 50% of the liquidation value, means whatever the creditors have claimed, if their claimed value it is less than 50% of the liquidation value, the number of representatives required, that is maximum of 2. If it is at least 50% of the liquidation value, it is 4. Similarly, for unsecured, if the liquidation the if the claimed value is less than 25% of the liquidation value, maximum 1 representative. If it is at least 25% of liquidation value, it is maximum 2. Now, workmen employees 1 1, government 1 1. Now, can anyone say me that, see, these creditors, these financial creditors means bank, financial institution, if they are having the security of the borrower, then they could have used this security. They could have recovered the money by selling the assets, by using these securities. Then why they are involved in the CIRP process? Anyone? Why they are involved in the CIRP process? They could have used the security, the assets. Anyone? See, it is because they may think that might be I can make more money from the CIRP process. Okay, that is why these creators they relinquish their security in the hope that might be in CIRP process I will get more money. I can claim for more huge amount. All right, that is why they relinquish it. Now, operational creditor, because only unsecured operational creditors are there. So, if the liquidation value, if the creditors admitted during liquidation process, the claimed value, if it is less than 25% of liquidation value, how many representatives are required? That is one. If it is at least 25%, then two. At least 25 means it can be more than 25, but it should not be less than 25 because it is already covered over here, less than 25. Now, next is preliminary report. So, liquidator will submit the preliminary report to NCLT within 75 days from the actual liquidation process has been started. From that date, within 75 days. Now, asset memorandum we have already done. Now, this is for PIRP. Now, PIRP is what? It is for mainly MSME. And what is the limit? The limit is up to 1 crore. It is up to 1 crore. So in this case, the PIRP process will be used, not CIRP process. Now, so who can use the PIRP? So only MSME, that is micro, small and medium enterprises can use PIRP if their default is up to 1 crore. If the default is more than 1 crore, then the company will use a regular IBC, that is CIRP process. Now, if there is gap between two PIRP and CIRP process, then so if the company has already gone through PIRP or CIRP process once, it cannot start another PIRP for 3 years. So 3 years you have to wait for that. Means the cooling period of 3 years is provided. Now, what if both CIRP and PIRP applications are filed? Then see, it happens now. Sometimes both applications may be filed for the same company. So then this rule applies if PIRP is filed within 14 days of CIRP filing, then PIRP will apply. If PIRP is filed within 14 days, means like right today, 29th November, CIRP has been filed. Okay, and after that PIRP, if it is filed within 14 days, then PIRP will apply. Why? Because this is for MSME. But if PIRP is filed after 14 days, then the normal CIRP would follow. The CIRP will go ahead, PIRP cannot replace that. So within 14 days, you have to file what? PIRP, then only you can proceed with that. Now, so this is 14 days. CIRP will proceed with now initiation. So IBC, see, normally CIRP process, it is creditor in control and PIRP process is what? It is debtor in control. Why? Because corporate debtor starts this process. So PIRP is what? It is a debtor in possession model. Now, normal timeline is what? It is 120 days. Now, in within 90 days, the actual commencement should commence. The resolution plan should commence from that when the committee of creditors have approved everything. And the total time frame is provided 120 days. No extension after that. After 120 days, no extension is there. Now, it is applicable under section 29A. So this is the difference between PIRP and CIRP. MSME, it is for corporate debtors up to 1 crore, more than 1 crore. Corporate debtor, it is financial creditors who can initiate any financial creditor, any operational creditor, any corporate debtor. Now 90 days to submit the resolution plan and it can extend to 20 days for the entire process. No further extension is there. But in CIRP, 180 days is provided, but it can extend it to 330 days. It is debtor in possession, it is creditor in control. Section 29, Section 29A. Now, moratorium period is provided from the date of commence, and moratorium here is provided when the application has been, when the NCLT approves the application. Can terminate the process when 66% of committee of creditors have voted. Majority of creditors have voted, then means majority means 66%. And here anyone can withdraw from this CIRP process when 90% of the COC have said yes. Then have voted then. All right. So this is all about your module C, credit management. So we have completed module C. Now let's start module D, that is compliance functions in bank. Now, so module D is all about the compliances. It basically talks about the rules, guidelines, protocols, the how the companies, how the banks they are following compliances of the RBI. So what is compliances in bank? Compliances means what? These are the laws, these are the regulations, standards, the ethical practices that the financial institutions are following or not. So whatever guidelines the RBI has set, those guidelines are followed properly or not. Now, primary goal of compliance is to ensure financial integrity, mitigate risk, protect customers and shareholders. Now, this is important. Now, the definition of compliance risk is given by BCBS. So, BCBS says that what is compliance risk? It is the risk of legal or regulatory sanction, means if the bank is not following the laws, not following the regulations properly, if the bank has made a huge loss, or if there is negative publicity of a bank, then in all these three cases, the risk that will arise that is called compliance risk. Now, next we have compliance risk and other regulatory risk. So operational risk I have done. Okay, we have done operational risk. So it is the risk loss of resulting from three factors, that is people, process and system. Now legal risk is what? When the banks they are not following proper orders, proper laws, proper regulations, then legal risk is there. L stands for legal, that is L loss. Reputational, when there is negative publicity, like if okay you are going to open your account in XYZ bank. Now suddenly I met you in the market. Okay, we are talking and I'm asking that where you are going. You are saying that I'm going to open an account. Now I will say that okay, don't open your account in XYZ bank. This bank charges extra money. This bank does not talk to their customers politely. Okay, and this bank always delays all the process. So what is this? This is a type of negative publicity. I'm giving you a bad reputation against this XYZ bank. So that is reputational risk. Now, annihilation risk is what? When there is complete loss of the bank. Complete loss bank faces. If bank is not following the regulations properly, then RBI will cancel the license of these bank and the bank regular operations will shut down. Now, business risk is the risk of when, see, it will affect your current earnings. So, when your day-to-day operations, when your daily transactions, when this is affected, when this affect your current earnings, that is the business risk. So, it has a negative impact on the operation, on the regular business or profitability. So, it could be from external conditions also, from internal conditions also. Now, external factors pestle internal conditions like internal policies are not good, the employees are not working properly, employees are having less skills then. And strategic risk is what? See, business risk, it affects only your current earnings. But if proper planning is not made, proper strategy is not made, then strategic risk will affect your current plus your future earnings. So both the earnings this will affect. Arises from adverse business decision. If the bank is not having the proper managers who can take better decisions, who can take informed decisions, then strategic risk is there. Now, next is compliance policy. So, what is this policy? Policy means what? Policy means guidelines, principles, standards that everyone has to follow. Now, so in his master direction, in his circular direction, RBI has advised all the banks that you have to follow compliance policy. So, whatever policy we are making related to compliances, all the banks they have to follow, and within 6 months from the date of the circular on the basis of the framework. Now, what are the elements? What are the things that this policy will contain? It will contain the compliance objective. Objective means that why we need compliances, why there is necessary that every bank will have to follow these compliances. Then scope of compliance function at office, zonal office, regional offices, and what are the role and responsibilities of CCO. So, in every bank, the officer is appointed to check the compliances, and that officer is known as Chief Compliance Officer. Now, for checking the quality assurance of the policy, the policy has to be reviewed at least once in 3 years. Okay, for maintaining, developing, and maintaining the quality assurance program, the policy has to be reviewed once in 3 years. And in normal cases, the policy has to be reviewed at least once a year. It is for maintaining quality and improvement programs. The quality assurance and improvement programs subject to independent external review at least once in every 3 years. And when policy is reviewed every year. So at least once in a year. So you can review it more than once, but at least once. Now, next is what are the roles and responsibilities of Chief Compliance Officer, that is CCO. Now, so first is tenure for appointment of CCO. So CCO shall be appointed for a minimum fixed period of not less than 3 years. Transfer removal of CCO. So CCO can be transferred, removed before completion of tenure, but only in certain cases, not in every cases. And that too the approval of the board of directors are mandatory. When board of directors will say, then only that CCO will get transfer, will be removed before the completion of its normal tenure, that is not less than 3 years. Now, what is the eligibility criteria for appointment of CCO? What is the rank? That at least not below 2 levels from CO. It means if CO is sitting over here, that 1 level below, 2 level below, 3 level below, means the CCO shall have the rank to this level, not below to this level. Done. So it should be at the equivalent position of a general manager, not below 2 levels from CO. Age 55 years age. Experience, the CCO should have the experience of at least 15 years. And out of this 15 years, the 5 years, the CCO should have worked in audit department, finance department, and in all other departments. Now, what are the skills that the chief compliance officer should have? So CCO should have a good level of experience. They can understand the work well. They can handle everything better. The CCO can take independent decisions. CCO cannot do any kind of biasness. CCO cannot be subjective. So CCO can take any kind of action. And stature means high level of respect. So CCO shall have the ability to independently exercise judgment. Means CCO can take independent decision. He should have the freedom to talk with anyone, to have communication with anyone. Why? Because CCO is maintaining the compliances, is checking the compliances. So for that, the officer should have the communication with everyone. So they can directly interact with the regulators, supervisors to ensure compliances. Now, others means no any kind of illegal cases should be there on the CCO. Means there should be no pending cases against the CCO. Now, how CCO will be selected? So for selecting CCO, a committee is made. Okay. On the recommendation of that committee, the CCO will be appointed. Now, which is that committee? Senior Executive Level Selection Committee. So, on the recommendation of this committee, the Chief Compliance Officer would be selected. Reporting requirements means when the CCO is selected, when CCO is transferred, or when CCO is removed, now to whom you have to provide the reporting. So prior intimation means you have to provide the information to Department of Supervision, RBI Central Office, Mumbai. That now we are appointing a new CCO or we are transferring this CCO. So that is you have to provide the prior intimation to Department of Supervision. Now, reporting line that if CISO is having any problem, any issue, or the officer is making any kind of report, now to whom that officer will submit the report. So, officers shall have direct reporting lines to MD and CEO. And in case the CCO is reporting to MD and CEO, the audit committee of the board, that is ACB. So, ACB will conduct one-to-one meeting with the CCO. And in that meeting, because it is one-to-one meeting, so no senior management, MD and CEO would be present in that. So audit committee of the board shall meet the CCO quarterly. Okay, meeting is conducted quarterly. One-to-one basis without the presence of senior management, MD and CEO. Now, authority. So CCO will have to communicate with every people. They have, the CCO would be given access of all the records, all the data, all the information. And why? So that the CCO can perform better responsibility in respect of compliance issue. So if CCO is checking the compliances, then officer should communicate with any staff member. Officer can have the access of all the records and files that are necessary to fulfill his responsibility. So this topic is very, very important. The role and responsibilities of CCO. Now, the same role and responsibilities you will study in your NBFC chapter. So there I have not included because the same slides is there only. So same tenure, same transfer, all the things are same. So that is why I have taught you over here. So there I'll skip it. Now, next is dual hatting. Now, what is dual hatting? Dual hatting means two hats. Means one person should not be given two hats at the same time. Means one person should not be provided two responsibilities at the same time. Why? Because these responsibilities will bring conflict of interest. So there shall be not any dual hatting, that is CCO shall not be given any responsibility which brings a conflict of interest. Only one responsibility the CCO can perform which is not bringing any kind of conflict of interest. Now, what is that responsibility? That is the role of anti-money laundering officer. So it can be performed by CCO. Now, CCO shall not be member of any committee which brings the conflict of interest. If the CCO is member of any committee, then CCO can only give advisory rules. The CCO can only provide suggestions. The CCO cannot perform the work, cannot do any kind of work. Only give suggestions or advisory rule. Why? Because it creates a conflict of interest. Okay, now next unit is all about compliance audit. Now, audit means what? That is verification of financial statements or examination of financial statements, books of accounts, okay, risk. Now, so compliance audit, and in that audit, if you are checking the compliances, so that will become compliance audit. Now, so what is compliance audit? It is a detailed review and evaluation to ensure that organization is following all the laws, organization is being adhered to all the regulations, policies and standards. Why? So to bring efficiency in the bank. So to bring effectiveness in the bank. So checking internal as well as all the companies, policies and practices. Now, what is the feature of compliance audit? To find if there is any kind of gap or violation, and ensuring that all the banks, all the department, all the different areas, they are following these rules and guidelines. Now, what is the scope? It covers areas like financial reporting, data protection, anti-money laundering, employer practices, all this. Now, what is the process of compliance audit? So first, in compliance audit, all the policies will be reviewed, that all the policies that RBI has formulated. Okay, now after reviewing all the policies, all the records, all the statements would be checked of the company, that what are the, how transactions are being done, if there is any kind of hidden pattern in the transactions, any kind of suspicious activities. So this needs to be analyzed. Then after that, the auditor will do the interview of the employees, of the internal employees, the stakeholders, that so that they can know well that how these employees are working, how these employees they have mentioned everything in their books of account. And after that, if the auditor has found any kind of issues, any kind of risk related to that. Now, for that, risk management practices are followed. Now, why this is done? To find the exact reason, to find if there is any kind of issues, if there is kind of any kind of technicalities, risk or non-compliance done, and if there is any kind of issue or risk, then to improve that, corrective actions would be taken. Now, next is the role of risk-based internal audit, that is RBI. Now, role of risk-based, see, RBIA is what? Internal auditor. Now, and this internal auditor will manage the risk also. Not only the books of account, not only the statements, but the auditor will manage the risk. So it is not about auditing the risk, but it is about how you can manage the risk. Because you cannot completely eliminate the risk. What we can do, we can only manage risk. And three factors are there for managing the risk. First is risk identification, assessment, and mitigation. Now, identification means like these are different types of risk in your bank. Credit risk, interest risk, market risk, then currency exchange risk, compliance risk, operational risk, annihilation risk. Okay. Now, these are different types of risk you have identified. Now, from these type of risk, number one risk, third, fourth, sixth, and seventh. So these are the risks that are very much harmful for your bank. Now you have assessed that number one, number third, fourth, sixth, and seventh number of risks. These are very much harmful. Now first you will try to mitigate these risks. After mitigating these risks, then you will work on your rest of the risk. So that is known as assessment and mitigation. So first you have identified the risk, that 10 risks are there in our bank. Among that 10 risks, 4 risks are very much harmful. So you will mitigate the harmful type of risk, and then you will work on your rest of the risk. So that is risk-based internal auditing. So Institute of Internal Auditors defined RBIA as a methodology. Methodology of what? That connects internal auditing with overall risk management framework. Means auditing is also there and you are managing risk at the same time. So that better risk management process you can adapt and you can work on that. So RBIA is not about auditing risk, but it is about auditing the management of risk. So it focuses on the process applied by the management. corresponds to individual risk, then different some more types of risk. So all banks will adopt risk-based internal audit. Why? To make a robust mechanism to examine the bank's internal control, to work on that, and including the systems, procedures, governance are properly followed and uh, approved by the RBI, that so that one can mitigate all these types of risk if they are arising in our bank, if they are creating a negative impact in our bank. Now, next is listing of securities. See, what is listing of securities? If any bank, if any company, okay, or if any institution, if they want to list their shares, list their securities in the stock market. Now, so they have to enter an agreement, and that agreement is called what? Listing agreement. Now, who will sign? Bank will sign the agreement with the stock exchange, and that agreement is called listing agreement. So the companies, including bank, if they are desirous of getting their securities listed on the stock market, on the stock exchange, then the banks or the stock exchange would have to enter in an agreement with the stock exchange called a listing agreement. Why? To make certain disclosures. Now, why these disclosures are mandatory? See, if you have a company, if your securities are listed, it means you are going public. If anyone is purchasing your securities, it means they are knowing very well your company. So you are going public, and if any minor changes if you are making in your company, you have to provide information to the stock exchange that these are the changes we are making. So for that we have to conduct one meeting. So prior intimation is provided to stock exchange, to the shareholders that come and join this meeting. We will discuss all these things. These are all agendas that we will discuss. And for that, every type of under each and every regulation, some of the points are mentioned. Now, so prior intimation is provided under regulation 29 is there. Then we have regulation 30. Then we have regulation 46 and regulation 47. So these are the four regulations that you have to remember. And listing agreement, LODR, listing obligation and disclosure requirements. Again, this topic is very important. Now, so what is regulation 29 now? So listed entities shall give prior intimation at least 2 working days in advance, excluding the date of intimation and date of meeting to stock exchange. Like suppose today is 29th of November. Now, if you want to conduct a meeting on 29th of November, so you have to 28 November, 27 November, and 26th November. Now, by 26th of November, you have to provide the intimation, that is information to the stock exchange that we are conducting one meeting on 29th of November, and these are all the agendas that we will discuss. So, in this date of meeting, date of meeting is not included. Then, excluding the date of intimation is not included. So, at least 2 working days in advance. So, assuming that all four are working days, so that is by 26th of November, you have to provide the intimation. Now, what are the things you will discuss in that meeting? For why you are conducting the meeting? To discuss all these things. Financial result. If you are buying back your securities, means company is buying back its securities, or if company wants to delist its securities from the listed entity, or if any kind of extra funds are raised by the company through issuing of shares, if any kind of AGM or EGM is conducted, okay, or the information should also be provided related to these to AGM and EGM, that is annual general meeting, and one is extraordinary general meeting. Now, next is if company is declaring or recommending any kind of dividend, okay, companies issuing convertible securities, companies issuing convertible debentures, company is declaring bonus securities to their employees. So any of the things if companies are discussing, so they have to conduct one meeting, and in that meeting they have to provide all the information. Now, and some more points are there. Any alteration in form of nature. Now, this is also 2 days. So you have to inform before 2 days. Now, previously it was 11 days, but now it has been changed from 11 to. So here also 2 working days, and in here also 2 working days in advance. So if there is any kind of alteration in nature of securities, if you are changing the right and privileges of your shareholders, then redemption of debentures, redemption of shares. Okay, if you want to discuss on this, then all this will be included in a regulation 29. Then any doubt to anyone till here? Then we will move forward. Now, next is what? Next is regulation 30. Now, in this regulation 30 of SEBI, it talks about two elements. What is one is para A and one is para B. Now, what is para A and para B? Now, events that need to be disclosed and can be described broadly in two categories, para A and para B. Now, para A means if even you are making a minute change, a minor change, you have to disclose that to the stock exchange. You have to disclose that to the shareholders. So, events that have to be necessarily disclosed means these are mandatory without applying any test of materiality. And in para B, if bank feels that these are important to disclose, then only those things will be disclosed under para B. Otherwise, not. Now, so what are the things that are included in para A and para B? So these are all the things. So in para A, no materiality test means you have to disclose it, and in para B, you have to disclose it if it is material. Now, what is included in para? Issue for feature of buyback of shares, revision of ratings. If you have conducted the board meeting, now what is the outcome of the board meeting? What is the final result of board meeting? The agreements of shareholders, joint family, then frauds, default of the promoters. So if any promoter has done any kind of default, any kind of fraud, if your promoter is arrested, if your key managerial personnel is arrested, then if you are changing your directors, KMP, then if there is any appointment or discontinuation of agent, then CDR, one-time settlement. So these are all that will included under para A. Now, similar para B means if important, then only it needs to disclose. So what are the things that are included in para B? So commencement or postponement of any commercial operation, then change in general character or nature of business, if you are launching any additional product, if you are if there is any kind of contracts you are entering in that contract, any legal agreement is there, if the regulatory framework is being changed, if regulations are changed by RBI. So these are well considered important. All right. Now, any doubt in this? This is all about Regulation 30. Now, Regulation 46 talks about that some information needs to be disclosed on the website. On the website as well as on the newspaper. So newspaper is Regulation 47 and website is Regulation 46. Now, so listed entity means any bank, any institution shall distribute the following information on its website, and it needs to be keep updated within 2 days of any change. Now, within 2 days here also, details of business, terms and conditions, establishment of vigil mechanism, composition of various committees, then following proper code of conduct of board of directors, if there is any kind of policy changed with related party transactions, okay, making subsidiary companies, making the policy for whistleblower. So all these would be intimated on the website. It should be updated on the website. When any changes are made within 2 days, all the things to be updated over there. Now, in a newspaper. So these are the things that needs to be published in the newspaper under regulation 47. Now, what is and in newspaper, two newspaper. One is in your regional language and second is in English. So regional language means the local language. So listed entity shall publish the following information in two newspaper, one English and one local regional language. Now, what are these? Notice of meeting of board of directors, financial result. Okay, if there is any kind of deviations on agreements or variations on annual report, notice given to shareholders. Okay, so all these are the things that you will publish it in the newspaper under regulation 47. Now, but among all these regulations, this one is very, very important. Although the entire topic is important, but this is very important. Don't miss this regulation 30, para A and para B. So, what are the elements that will come under para A and what are the elements that will? So, this is para B and this is para A. All right. Now, let's start the new unit that is unit number 28. Corporate compliance governance structure. Now, what is structure? What is governance? What is compliance? So, compliance, you know it very well that these are the rules, regulations, guidelines that are properly followed or not, laws, all the regulatory sanctions. Now, governance structure means that a hierarchy. Structure means a hierarchy that who will report to whom, uh, you will report to whom will report to you. So all these are what? These are the patterns or the roles defined to each and every individual. Now, so Chief Compliance Officer, that is CCO. Now, this CCO will act as a middle person. Why? Because all the compliance officer at regional office, zonal office, branches, so they will provide the report to CCO. The functional departments at central and head office will also provide reports to CCO. And CCO will further provide reports to board of directors, to ACB, audit committee of the board, or managing director and CEO of the bank. So the CCO will further report to these three people. Now, next is what? So bank senior management with the assistance of compliance department will have to ensure all these things. So the senior management who is working in the category of banking, and with that senior management with the help of compliance department will ensure that all these things need to be followed properly. Why? To what? To keep the board and senior management informed about laws, rules, regulations. Okay, if there is any kind of new development, if there is any kind of compliance related issues, then all the clarification is required to conduct assessment on the compliance risk at least once a year. Make a plan so that you can mitigate all your risk. Then, if any kind of changes are there, if any kind of issues arising due to compliance risk, then the proper report, prompt action has to be taken. Report has to be submitted to our board of committee, managing director. Then periodically report on compliance failure and breaches. So if any of the bank employee has breached any kind of contract or done or following done non-compliances, then it needs to be properly reported. Okay, so board and ACB, it needs to be reported to the board and ACB and all the functional heads concerned to all the functional heads. Then to monitor and test compliance by performing different compliance testing and also ensure that all the actions are taken timely and effective compliance is done with RBI. So to mitigate all the risk, to work on the proper plan and to ensure that all the activities are done in a proper manner so that no non-compliance is there and no risk is emerging there. So these are the things that need to be assured by the senior management of the bank with compliance department. Now, Next, we have the compliance structure at corporate office. Now, corporate office means CDCO, compliance department at central office. So, what is the compliance structure at corporate office? See, compliance department, they have their own formal status, and it has to be, it should set a central office at the head office so that all the reports are submitted to ACB. So for that, a senior a person should be appointed at senior level that can handle all the compliances, that can ensure that whether the compliances are being followed in the bank or not. And for that, one officer is appointed, and the name of that officer is what? CCO, Chief Compliance Officer. So CCO will ensure all the non-compliances, all the compliances. Now, so there are main sources of factors that is used to find out what compliance rules the bank need to follow. The bank need to follow master circulars of RBI, master directions of RBI, and in directions whatever the policy is being formulated by the RBI. So all policies are to be implemented and updated. Then RBI guidelines which are issued from time to time, different laws, and all the internal guidelines and policies of the bank. So these are to be followed by each and every bank. Why? So to maintain regulatory focus, nature of activity, that is all types of risk should be reduced, and banks exposure to materiality means mandatory event and non-mandatory event. Or if any breaches reported of the in the past, if any breaches are reported of that bank, that needs to be checked also. Now, next we have topic that is internal control, and it's important. Now, what is internal control? So in internal control, if you will see, one word is always related, that is known as internal audit. Now, it seems that IC and internal audit, these two are same, but no, there is the difference between internal control and internal audit. Like, let's understand this with the help of HRM and HRD. Now, yesterday, you have seen that which is having a broader scope, HRM. Why? Because it is a management part, and in management, all the things are included. And HRD is what? It is a narrow scope. So in HRM, the thing which we do, okay, the development criteria, so that is known as HRD. So we can say that HRD is the subset of HRM. So similarly, IC and IA, internal control and internal audit. So in internal control, we control all the things, the policies, the procedures, the systems, okay, the activities done in the company, the compliances being followed. This is what we do in internal control. And internal audit is what? It is the examination of entire company. The books of account, the financial statement, the compliances, the risk, the all the exposure limit, the concentration power, everything. So IA, so we can say IC, it is the part of internal audit. So in internal audit, we do internal controls also. So internal control is a part of internal audit. So internal control and audit, these are closely related. They are distinct from each other. Internal control is the system, policies, procedures. Okay, and internal audit, it provides an objective, independent review of the bank. Internal control, see, it is included the internal control. So internal control is a part of internal audit. Internal audit is different. Internal control is different. Now, so this is the difference between internal control and internal audit. Now, in internal control, it is the system of rules, procedures, checks created by management. And internal audit is what? It is an independent review of the entire work, entire internal control. Internal control is done to prevent errors, frauds, and ensure smooth operation. And internal audit, it helps to detect the weakness. It helps to find the root cause of the problem. Why this problem is arising. Internal control helps to find the problem, that these are the issues, these are the problem. But internal audit helps to find the root cause of that problem. Internal control, it is done for daily operations. It is a continuous, and internal audit, it is done monthly, quarterly, annually. Management and all employees are responsible for this. Internal audit department, and auditors are important. So it controls and prevent things. It internal audit, full examination, evaluation, and reporting is done. So it ensures compliance and accuracy. It provides assurance and recommendations for taking corrective actions. So internal control is what? It is a part of internal audit. Now, so we have total six aspect of internal control. Now, six aspect of internal control is first is information system. Now, information system is what? It means that your system is supporting you. All the internal controls are in a place to ensure integrity, security of the banking system. That the proper banking computer systems are supporting you, providing you all the information, all the data are stored properly. Now, segregation of duty means that every person they have given their respective roles. They are given their own responsibilities and all are performing their work. Audit program is what? It is an independent action. Okay, a process that should be independent, reporting to the board without any kind of conflict. The auditor can take independent decisions, okay, without any kind of interference of any other person. And the verification of member account needs to be performed at least once every 2 years. Now, record keeping means keeping all the records, maintaining all the records with the proper accounting principles are followed. Protection of physical assets means the protection of assets are accomplished by developing operating policies. So all your assets, all the physical security of the computer, the stocks, everything should be kept in a place where it can be get better protection. And education of staff means the people who are working in your bank, the employees who are working in your bank, they are trained enough to handle any kind of difficulties. They are trained enough to do their regular work, their regular operations. So thoroughly trained in specific daily operations. So these are the six aspects of internal controls. Okay, segregation means what? Distribution of duties. So every individual has defined their own roles. They have to perform their own roles. All the duties, all the resources are distributed according to the caliber of the individual. All right. Now, next is five basic rights of bank customer. So, what are the five basic rights of bank customer? So, first is right of fair treatment. That every customer should be treated fairly. No discrimination should be there on the basis of gender, age, or income. Right to transparency means the bank should provide each and every knowledge related to their products, related to their services to the customer. Right to suitability means the products which the banks are offering to the customers, it should suit according to their financial needs, according to their customer needs. Right to privacy is all the data and information of the customer should be stored at one place. Okay. All the data should be kept confidential. All the information of the customers should be kept confidential. The bank does not share customer account details with anyone without the consent. And right to grievance redress compensation is that if customers are having any problem, any issue, then it's your responsibility, the employees of the bank responsibility that they have to provide them a redressal mechanism. And if not, then customers they can reach toward to the ombudsman. So this facility should also be provided to them. All right. So we have completed till unit number 28. Any doubt to anyone so far? And I hope you all have subscribed the YouTube channel so far, those who are watching. And if sessions are helpful, do like the session as well and share it with others. All right, so we have completed till unit number 28. Now 29, 30, 31, 32. 4 units are left. Now, so these 4 units we will complete after having the break for 10 minutes. All right, so let's start after 10 minutes. So it's 8:24. So we'll proceed with 8:35. Okay, sure. All right, I guess everything is okay. Okay, now, so we have completed so far, we have completed till unit number 28. Now let's start unit number 29. That is all about framework for identification of compliance issues and compliance risk. So already we have studied a lot about compliance risk, different types of risk. Now some more types of risk you are having over here also. Now compliance risk is, so BC Basel Committee on Banking Supervision has given this definition: the risk of legal or regulatory sanction to banking activities. That is, if the banks are not following laws, if there is any kind of financial loss, or if there is negative publicity of a bank, then all these risks will come under compliance risk. Now, some more types of risk are what? Operational, inherent, and control. So, operational risk we have done several times, that this is the risk which a result from inadequate or failed internal process, if people are not caliber enough, and if your system is not supporting, or from any external event, if any such type of risk occurs, then this will come under operational risk, like power failure to floods or earthquake or terrorist attack. Now, what is control risk? See, even if you have used a lot of control measures, now we know that the IT system is not supporting well. Now, so you will use new recent updated technologies, or you will change your computer, or you will change your software. So these are the things you will do. That is control measures you will use so that your risk will reduce. Now, even if using control measures to overcome all your types of risk, still there is some type of risk that will lift. And that leftover part of risk is known as residual risk. So control risk is what? It is the chance that companies' internal controls like rules and procedures are designed to prevent errors that might not work properly. So even if you are using control measures to control your control risk, to control your operational risk, still there is some type of risk which is left, and that is known as residual risk. Now, what is inherent risk? Inherent risk includes a number of things. Like one best example given in your book. Now, what is inherent risk? See, if you are crossing the street, okay, if you are crossing street, you are going from this side to that side. Now, there are infinite number of risks. Like when crossing, okay, there are different vehicles. There is high probability and large impact that this person would get hit by a car. So to mitigate such risk, this person will look left, this person will look right, and then this person will cross the road. But still, there are chances that this person may hit by an accident. Why? See, so to mitigate a risk, we will implement the control of looking left side, looking right side, and then we will cross the road. But this will not completely eliminate your every possible risk. For example, you could still be hit by a meteor. Why? Because you did not look up in the sky. So there are still chances, even if you are using control measures to control your risk, but some part of the risk will always be left over. And that leftover part of risk is known as residual risk. So inherent risk, control risk, residual risk. I hope it is clear to you. And this is what? This is the equation of inherent risk and residual risk. Now, so compliance risk score, how it is to be assessed. If your risk score lies from 1 to 3, between 1 to 3, so it is means you are controlling good, well controlled. Your bank is controlling a good level of risk. Now, if it lies from 3.1 to 5, it meets the requirement. 5.1 to 7, it needs improvement to control risk. And 7.1 to 10 means needs significant improvement to control risk. And also there is one case study given to you. Like a compliance audit was conducted at XYZ Bank, and following issues were identified. Now, what were identified? Delayed reporting were there of suspicious transactions and minor breaches done in KYC. Then some mandatory trainings, these were incomplete. No major frauds were found and no violations were observed. Now, on the basis of this, findings. What was the compliance risk score? It is 6.2. Now this 6.2 will come under which type of risk level? Well controlled, meets requirement, needs improvement, or needs significant improvement. So we have seen that 6.1 lies from 5.1 to 7. It means it needs improvement. That is option C. Now, next is reporting framework and monitoring compliance. See, what is reporting framework? The structure pattern. If any of the non-compliance occurs, it occurs from the base level. Now, what is the base level for the bank? The base level is branches. Now, these branches, if they will do any kind of non-compliance, they will report to whom? They will report the to RO and ZO. Then RO and ZO will provide reporting to the CCO, CDCO, okay, that is compliance department at central office, and one copy will also be provided to the risk officer. So ROZO should make a copy of certificate to risk officer. Then functional department will provide all the reportings to compliance department. Then overseas branches will also provide all the reporting to CDCO, and a copy of the report is provided to the regional office. So these are what? These are the reporting framework that all the non-compliances will be reported by branches to RO and ZO. Then RO and ZO will provide all the reporting to CDCO. Then the functional department will provide all the reportings to compliance department, and overseas branches will provide all the non-compliance reporting to the CDCO. So this chart is very, very important. Now, gist of the report means who will report to whom? Who will report to whom? And this is to whom it will be reported. To whom it will be reported. Here, who will report, and here to whom it will be reported. Now, so branches will report to RO and ZO. Branches will report to RO and ZO. Then RO and ZO will make one copy available to the risk officer. RO and ZO will provide one copy to risk officer. Then RO and ZO will report to whom? RO and ZO will report to CDCO. Then on quarterly basis, this we will do later on. Now RO and ZO will provide one copy of the certificate available to whom? Risk officer. Now then functional department will also provide all the reportings to compliance department. Overseas department will provide all the reporting to whom? That is compliance department, chief executive of the center with the copy. Okay, so this is all the reporting structure that is provided by another party, that is branches to RO and ZO, then RO and ZO to risk officer to then again CDCO, functional department to CD, and overseas department to whom? That again CDCO. Now, so what is overseas branches, overseas centers? Overseas branches are what? See, it is mainly, it is a like if your Indian bank branch is situated at any foreign country, then how you will going to check its compliances? How you will going to see that whether rules are followed or not, guidelines are followed or not? So we can't supervise. We don't know what is the situation of market over there. So for that, we will hire one local officer to check the compliances of overseas branches. All right. So in this way, the reporting will be done. Now, branches to RO and ZO will provide reporting quarterly as on last quarter within 5 days of the closure of quarter. Now, what is this? See, if you will see, all the things are provided quarterly, but in overseas branches, it is provided monthly because it needs to check in other country. So that is why the monthly reports are provided. Now, as on last working days of the quarter, suppose we take which quarter? April, May, and June. Now, last working day of the quarter is what? 30 June. So, within 5 days of the closure of quarter, now you are closing your quarter on 30th June. So, after its 5 working days, 1, 2, 3, 4, 5 means by 5th of July, you have to provide the reporting, that is quarterly. Here also within 10 days, RO incentive to compliance department. So by 10th of July. Here also by 10th of July. And here you have to do the reporting monthly within 5 days of completion of month. So every month after completing that month and within 5 days of completion of that month, like 5th of February, okay, 5th of March, 5th April, like this. So this is all the reporting. Now, what is credit audit? Just now we have seen credit audit is the thorough examination of an individual's company credit history, okay, past history, credit related activities. This is we will do the audit. The statement of books of account, all the credit related information is checked, all the compliances are checked, also checked all the laws are followed or not. So objectives of credit audit is improvement of quality of credit control, then checking the regulatory compliance, okay, feedback of regulatory compliance. If there is any kind of early warning signals, then how you will take measures for that, how you will going to improve the credit quality, credit administration, okay, how the credit sanction process is done, how you will review the large amount loans, the average amount loans, and the loans which are of very less risk, how you will review that. So all these are the objectives of credit audit. Now, so scope and coverage. So there are two scope and coverage. Again, portfolio review and loan review. This we have done yesterday also. So portfolio review is what? That is overall review. So we can say macro. So in macro, we will check the overall portfolio of the bank. But in loan review, we will check only specific things. So specific things means micro. So portfolio, it examines the quality of credit and investment. It also suggests the remedial measures for improvement, how we can improvise this, how we can reduce our concentration risk. But in loan review, if you are doing LRM, then you will check different loan account. Now, so bank will check either all the fresh proposals within 3 to 6 months of the limit, like up to 6 months the bank has provided, the bank has sanctioned to which sectors loan, that will be checked. Or the bank will set the limit that we will do the review of the loans above 20 lakh or above 30 lakh, that is the limit or cutoff limit is decided. Then bank will randomly select 5 to 10%, or bank will check those companies loan account, the bank has sanctioned, like if a company is having their subsidiary company, or the company is having any kind of transactions, the related party transactions, the sister concerns, the group concerns, even no matter what the limit is. So either of the any way you can do the LR, loan review. Now, frequency of loan is high risk account is checked in every 3 months. Average risk account is checked in every 6 months, and a low risk account is checked yearly, that is annually. So there are some of the benefits of good compliance culture. So how would one know that this bank is having good compliance culture? So if there is less risk, then we can identify that compliance culture is good. Low organizational individual risk, low reputational risk. If your employees are having so much confidence in performing their jobs, they are having a good level of skills, then helps attracting and retaining talents, improving transparency, enhancing better relations with outsiders, with regulators, with stakeholders, and also giving valuations, also giving more value to your investors, because investors will ultimately provide money. They will work in your company, so you have to provide them the same value the you are giving to your shareholders. All right, so these are all the benefits of good compliance culture. Now, next, we have unit number 30, that is all about compliance culture and GRC framework. Now, what is GRC? Governance, risk, and compliance. Now, so compliance culture is what the compliance culture means. If you're having a good environment in your bank, means all the of all the departments, all the employees are following compliances, no non-compliances is done, that is the good compliance culture. Now, so RBI has introduced a system of designating compliance officer. We have seen that what are the roles and responsibilities of CCO. And this is the designation provided when in August 1992. Now, this designation is provided as CCO based on the recommendation of Committee on Fraud and Malpractices in Bank. And this Committee on Fraud and Malpractices in Bank is also known as Ghosh Committee. So this line from here to here very important. So Ghosh Committee or Committee of on Fraud and Malpractices in Bank. So on the recommendation of this committee, the CCO is appointed. Now, so compliance culture in Indian scenario is what? So in order to follow a good compliance program in any bank, in any organization, all these are need to be followed properly. So written policies, so whatever policies, guidelines RBI has issued, the bank should implement that. The bank should follow proper code of conduct. Then every bank should have a compliance officer, a compliance committee. Proper trainings would be provided to the employees. Communication lines should be described properly. It should be announced properly that who will communicate to whom. Okay, who is at the top, who is at the bottom. All the activities, all the disciplinary guidelines are followed. If there is any kind of early warning signals, prompt action is to be taken to detect all the offenses and any kind of fraudulent activities are there. And if there is any kind of compliance risk associated with any employee, with any person, then talk to that employee, have good communication, work with that employee to mitigate all those risks. Now, next is what? So, see, the bank has said, okay, already these are all the things that are required. Okay, every bank will have to follow this. But some of the things that the RBI has made the different features. And if all the banks, all the regulators, they have to follow these attributes. So how to know that whether banks are following proper guidelines or not? So regulators will see these typical 10 attributes. Now, if these attributes are followed, it means the banks are following the proper compliances. So it is important to note that most clearly written comprehensive compliance program is destined without failure. So if there is no such environment created, then it is understood that the compliances are not followed. So that is why a good culture of compliance is being formulated by the regulators, by the RBI, based on these 10 typical attributes. Now, what is tone at the top? Tone at the top, what it says that if your top manager is not uh, aware about the risk, if your top manager is not following the compliances, then how the manager is expecting that their people will also follow the compliances. So it is important that the manager, the leader should take a prompt action, should be initiative, then only the rest of the people will follow the same practices. Then integration across the enterprise scheme is the bank, the organization or institution should not bifurcate all the activities. It is assumed, it is being considered that all the activities of the bank, all the activities of the company, they are one activity. So we should not create the walls between different activities like risk activity, compliance activity, governance activities. These are not the different things. These are interrelated to each other. So we should not create any kind of walls among these things. So we should treat them as it is the core activity of the organization and we have to maintain that. Now, silos is what? Again, the same. So it is important that compliance staff is present when business decisions are made. Does the firm seek their input? Means silos means that the business and the managers and the employees, they are not two different things. So if the manager is taking any decision, manager should include their employees. And if the employees are giving any ideas, the manager should properly respect the ideas of their employees. So the compliance department or any other department should not be walled off from rest of the organization. It is assumed to be the same. Now power. So all the power are provided to one senior most person and that is called CCO. So CCO should have the power to handle all the compliances well. Now, what is cowboys? Cowboys are what? If anyone is following any rules and regulation, so it should be followed according to the terms and conditions set by the regulators. Like if I'm doing any activity, so I should follow the company's rule. I should not create my own rules. I should not do that work according to my rules and according to my plans. No, if the company has made the plan, if company has made the rules, I should follow that. Resources means that if you are following compliances, if you are maintaining compliances, so it needs a lot of money because resources are to be distributed properly. And for maintaining compliances, for checking the risk, for checking governance, everything, you need to have more and more resources, a better technology, a updated technology, better skills, okay, better, you can say the power basis. So all these things are important and it will include cost. Now, employee buy-in is what? That is, employee buy-in means the employees should follow the proper rules and regulations. If any employee violates any kind of rules and regulation, then organization should have a zero tolerance policy for those employees who is doing any kind of misconduct and should have a continuing training programs. So employees should follow the rules and regulations of the company. If any employee has done any misconduct or any fraudulent activity, then company should not tolerate that. Company should immediately take actions against that employee. And living compliance program means what? That is the compliance policy, the compliance program. It should not be stagnant. If required, these policies should be flexible. That if the if risk is very high, then you can change the policies accordingly. So compliance program should not be stagnant, it should be flexible. So according to the things that are happening around the environment, around your surrounding, around you, so accordingly that you have to make your program, you have to tailor your program according to the need and demand of the environment. So these should be modified. Okay. Now, next, good and updated technology should be used. If you are using the old and conventional technology, then there are chances that the human errors are there, the manual errors are there. So you should use your updated technology, new technology, so that you can do your regular operations efficiently and effectively. And documentation is what? That is regulators, they love documentation. So all the reports should be properly submitted, all the compliance, strong compliance culture, all the records should be submitted to the top authority. Now, so this is what? This is all your 10 attributes that regulators look for any bank. So all the banks, they have to follow these 10 typical attributes. Now, next is GRC framework, that is governance, risk, and compliance framework. Now, so governance and compliance. So many times you will feel that governance and compliance, these two are the same thing. Governance also you are making, you are following orders. In compliance also you are checking that whether rules are followed properly or not. But no, there is the difference between governance and compliance. Now, governance is what? It is the framework for decision making, for taking action. It talks about long term goals, values, and compliance means how you will fulfill that target. Governance means the target, the decision making to achieve the goals. And compliance means how you will achieve that goals, what laws you will follow, what rules you will follow, what policies you will follow to achieve that goals. So it means specific external rules. Now, who is responsible for governance? Board of directors, senior management, and compliance. We have compliance officer, risk officer. It create value, transparency, accountability, and it checks that if any non-compliance is done, then the CCO will find penalty on that after providing reports to ACB. Then integrity is maintained or not. It is voluntary and strategic. It is mandatory and operational. Means governance is what? It is for long-term plan. So it is voluntary. If you feel, then only you can set this goal, then only you can set this target. But compliances, these are mandatory. So without following proper rules, you cannot achieve any target. Now, so governance means doing right things. That is governance. Strategy plus supervision. And compliance means doing things in a right way. Means if you are doing any thing, if you're achieving any target, if you're working on any goals, you should follow proper rules and regulations. That is compliance. So governance, leadership, and direction is there. Risk is what? It is uncertain. It can arise anytime. Okay, we have to check risk every time. We have to mitigate risk. We have to assess risk, and compliance is rules and obligation. Now, what is the goal? Make right decision. It is to avoid dangers and threats and follow the law properly. Now, what is the result of governance? Proper management is done here, because risk is there, so you will never know that what will going to happen, uh, in what will going to happen in just in next scenario. But compliance is what? These are no penalties or violation. So if you have not followed compliances, then only penalty will be there, otherwise not. Clear the difference between these three? Now, next we have that is GRC solution framework. See, if you will see governance, risk, and compliance. So in governance, risk is also included, compliance is also included. In governance, how you will achieve, how you will do, how you will make decision for your bank or company. So in that, you have to follow risk also. You have to maintain risk. You have to minimize risk. You have to follow proper orders and laws. In risk also, governance is included, compliance is included, and in compliance, if you will see, governance and risk are included. Now, so in every of these three activities, because duplication of efforts are there, duplication of activities are there, means in each one activity, three activities are there. In two activities, four activities are there. So things are repeating. So in order to make everything very smooth, a integrated platform is being introduced. So GRC solution provides an integrated platform for standardizing and managing strategic and operational risk, so that any type of risk can be mitigated soon. And if there is governance practices, follow that, make decisions properly, and compliances, follow proper law and order. So to develop an enterprise view of your own risk exposure through all common risk management stages. So including risk identification, assessment, and monitoring. So because these things are repeating in every of each, so that is why our integrated platform is created. So if one who wants to check anything related to governance, so they will follow the governance module. If anyone who wants to check anything related to risk, so they will go for risk control assessment. If anyone who wants to check anything related to compliances, so that person will check compliance module. So GRC solution is designed, it is a web-based application to automate all the above process. Now, above process means all this process. And every different application are being made in name of module. So incident management, if you want to check anything related to management, you will visit this module. If you want to check anything related to risk, how you can control risk, how you can assess risk, you can visit this module. If you want to check what are the risk indicators, you can visit this module. So similarly, different modules are there. So it will save your time also, and it will make it cost effective also. So you don't have to visit every module. Whichever module you want to see, you want to look, you will visit that module. If you want to see the compliances, how banks are following compliances, you will visit this module on the website. So that is why an integrated approach is there. Now, next is what? Next topic is again very important, that is whistleblower mechanism. Now, what is whistleblower? So, whistleblower means the person who makes aware to everyone by blowing a whistle. That is the meaning of whistleblower. So, in an organization, a whistleblower is a person who creates an awareness about any kind of wrongdoing, any kind of misconduct, any kind of fraudulent activity, any kind of illegal activities that are happening in the company or bank. So, what are the objectives? It gives employees, investors, contractors a platform. They can raise their concern against any wrongdoing done by the company. Now, this whistleblower policy, it gives the protection against the retaliation from the uh, from the act which is done by the whistleblower. Like whistleblower has informed all the wrongdoings of the company to the top manager. Now the one who is engaged in that wrongdoing, now that person will try to take revenge from the whistleblower. So that is why company will provide the protection against retaliation. The company is committed for doing business in ethical ways. Then company will give the stakeholders the liberty so that they can raise any kind of concern, and the company will try to keep all the data confidential about the whistleblower. Means the name should not be revealed by the company. But if the court says that no, the company has to reveal the name of whistleblower, then only the company will reveal. Otherwise, company will not going to reveal the name of the whistleblower. It is kept confidential. Now, what are the model policy guidelines? Model policy means these are the common policies. So common policies are what? That is, in normal sense, if you see anything bad happening in your company, you have to report it to the top manager. The top manager will see all the things that whether you have said in good faith or not. If you have said in good faith, then no action would be taken. If you have informed in bad faith, then action would be taken. Then there shall be no retaliation against the person who is whistleblower. Retaliation includes what? Suspension or decrease in salary. So there is no retaliation. Means no revenge is taken any act. Now, if any person becomes a whistleblower, so it's not written in the provision that company will give extra benefit to that whistleblower. No. If company wants, so voluntary company can give the extra benefit, but it is not written in any kind of provision. Then protection of whistleblower is provided two areas. The whistleblower confidentiality is to be maintained, and all the data has to be kept confidential. Then, if any person is uh, any person who is working along with the whistleblower, that person would also be given protection. No discrimination is done against that on the basis of salary. This person has provided the information. Now, the whistleblower would be provided more salary. No, not any kind of discrimination is done regarding the salary. The company cannot discriminate against an employee who is helping in the investigation. Then it is not under the provision that company will pay any kind of compensation. No. If company wants, company can give money, okay, according to the wish of the company, but it is not written in any provision. The name is kept a secret. All the proceedings would be checked. Okay, if the whistleblower, like whatever whistleblower has said, if it if it proves that no, this is wrong, then still the whistleblower would be given protection. Why? Because whistleblower has said in good faith. If not in good faith, then only protection would not be given. Now, so what are the areas that are covered under whistleblower policy? So any kind of harassment or discrimination. Okay, if any kind of confidential information is leaked in the company, that any kind of breaches is done by any employee, that is reported under whistleblower policy. Misrepresentation of financial data, corruption, illegal sales activity, invalid promotion is given. Even the person is not good enough to be promoted, but still because the person is having direct relation with the manager, so manager has given the promotion. So such kind of activity would be covered under whistleblower policy. Then conflict of interest, trading within the company. So these are all the things that are included in whistleblowing policy. If company is disposing assets, if company is selling assets through an illegal ways, the um, illegal competitive behavior of the person or the employees, they are doing backbiting. Okay, they are playing the games, they are using companies resources, they are selling companies resources for the sake of amount. Okay, some money. So that all will contain, that all are the areas that are included under whistleblower policy. Now, so whistleblower policy in India. So as in India, not that much protection is provided to whistleblower, but laws related to whistleblowing and protection of whistleblower are inadequate in India. But still in Companies Act, the provisions are laid down to the whistleblower that the whistleblower should be given protection, okay, and elimination of fraud by establishing a vigil mechanism. Section 206 to 229 lays down the provision relating to inspection and inquiry. Now, so draft 12.5 of the Companies Act says that section is important, that it is compulsory for all the listed company, point number one, companies that accept a deposit from public, point number two, and companies who borrow more than 50 crore of the bank, point number three. So if these any of these things are done by the company, so those companies have a compulsory action that that the company will have to maintain whistleblower policy. Now, and there are two types of whistleblowers now. Employees who reveal fraud, corruption, mismanagement to the senior management, these are called internal whistleblowers. Employees who report fraud or corruption to the media, they are known as external whistleblowers. So, internal whistleblowers, like you are revealing all the frauds to your senior management, internal. If you are revealing all the frauds to the media, so that uh, media will provide information to all other everywhere to in all companies. They can reveal to all companies. So that is called external whistleblowers. All right. So that was all about your unit number 30. Any doubt to anyone in unit 30, the whistleblowers? Now, next is what? Next is unit number 31. That is a compliance function and role of CCO in NBFCs. Now, already we have done the role of CCO in NBFC, so I would not going to repeat over here. Now, so compliance function of in NBFC. Now, see what happens traditionally because NBFCs were less, so there were less compliances in NBFCs. But now, because the NBFCs are the competitor of banks, so now the equal compliances the bank is following, so equal compliances the NBFC would also have to follow. So what is the compliance function of NBFCs? That is, so in NBFCs there are total four layers. Now, what is NBFC? Non-banking financial companies. Now, these companies they work just like bank, but few of the things they are not provided. Like the license is not given. They cannot take advances from the. They cannot grant advances to general public. They cannot take many NBFCs. They cannot take deposit also. So these are the few things they cannot draw check on themselves that are not allowed. So in NBFCs, four layers are there. Now, what are these layers? B, mud. B is base layer, M is middle, U is upper, and T is top layer. So, NBFC who is working in the lowest layer called base layer, middle layer ML, upper layer UL, top layer TL. Now, so base layer because it is working at the base layer, basic layer, so it has to follow less compliances. Now, less compliances is there, less strictness is there, less rules they have to follow. So, base layer comprise of point A, non-deposit NBFCs below asset size of 1000 crore. Below asset size of 1000 crore. That is non-deposit taking NBFCs. So, they are included in base layer. Now, next is those NBFCs who are indulged in all these activities, that is peer-to-peer lending platform, account aggregator, holding companies, and those NBFCs who does not have the direct relation with customer, means they does not avail any kinds of public fund and they does not have any kind of direct relation. So these NBFCs would come under base layer. Now, peer-to-peer lending is what? It is the technology which basically provides the benefit when if you don't want to visit the bank, then you can borrow or lend money from this platform. That is peer-to-peer lending platform. Now, middle layer is what? It is the second layer of NBFC. Now, in this also, what type of NBFCs will come? All deposit taking NBFCs, no matter what their size is, no matter what their asset size is, and all non-deposit taking NBFCs whose asset size is 1 crore or greater than that. Either 1 crore or greater than that, because less than 1 crore we have already included in base layer. So here would be 1000 or less than or greater than that. Now, and those NBFCs who are involved in all these following activities: the primary dealers, the debt fund, core investment companies, housing finance companies, and infrastructure finance companies. Now, what are primary dealers? So, these are those dealers who basically deal in government securities. The trading of the buying and selling of government securities in the primary market. That is why these are the dealers who deal in such activities. So, they will be included in middle layer. Now, upper layer, why? Upper layer of NBFCs, it is the third layer. And in this upper layer, more and more compliances this NBFC has to follow. More strictness is there because RBI has identified the upper layer as the highest layer as of now. Why? We have top layer of NBFC we have, but as of now it is vacant. So the NBFCs which are under upper layer, that would be have to follow more strictness. And how identification is done? Identification is based on specific criteria, including numbers and expert judgment. Now, numbers would be given weights of 70% and judgment would be given weight of 30%. So, first, how we will include, categorize all NBFCs under upper layer. So, top 10 NBFCs would be included in upper layer by asset size. Then other NBFCs would be selected based on the parameter of 70 and 30, 70% by weights and 30% by evaluation. Evaluation means the judgment. So 70% is quantitative and 30% is qualitative. Qualitative means expert judgment. Now, next is again uh, this Now, again, next is top 50 NBFCs we will include now. And in this top 50 NBFCs, top 10 NBFCs which we have included, this will not be counted. So, some different top 50 NBFCs would be counted over here. And some additional conditions are what those NBFCs who have worked in the previous year so would remain in this category. And if the RBI feels that no, this NBFC is now having more risk, so let's shift this NBFC to the upper layer of category. So that NBFC would include in the upper layer of category. So it is done on the basis of these criteria. Now, next is top layer. So as of now, top layer is empty. But if RBI feels that if NBFC is having any kind of systemic risk, then that NBFC would be kept under top layer. Otherwise, not. Now, so what are the regulatory changes under SBR? So initially, what RBI has said that all NBFCs they have to maintain the net owned funds up to 2 crore. If they are having net owned funds up to 2 crore, they are included in this category. But in scale based regulation, many things are changed. So now RBI has said that now the net owned funds, NBFCs, they have to maintain net owned funds of 10 crore rupees. But NBFC says that, okay, you are saying that we have to make it from 2 crore to 10 crore. But it is not possible, na? Spontaneously, we cannot make 8 crores, we cannot increase to 8 crore. So NBFC say that, okay, RBI says that, okay, I'm not telling you to increase from 2 to 10 crore spontaneously. So for that, we will give you glide path. Now, what is this glide path? That is a gradual increase. Means now current NOF, why it is written? Because this is the image of your book. And when this book, Macmillan book was published, it was published in the year 22 to 23. That is why it is written current. But now current it was 2 crore that time. Now NBFC says that okay, you have to make it 10 crore by March 31st, 2027. So you cannot make it spontaneously. So for that, we are providing you glide path. Means by March 31st, 2025, you have to make it 2 crore to 5 crore. Then from 5 crore to 10 crore. So this is NBFC ICC, investment core companies. Now, microfinance institutions, it is 5 crore current. By the end of 2025, it has to make 7 crore and then 10 crore. Again, NBFC factors 5 crore to 7 and 7 to 10. So by the end of March 2027, all NBFCs, they have to make it their net own fund. How much? Minimum net own fund, that is 10 crore. Now, but RBI says that, see, in base layer already the NBFCs who are working in base layer, they have to follow less rules, less strictness is there. So they can maintain, they can continue to be 2 crores only. There is no change in NBFCs under base layer. And those NBFCs who are not following all these things, then NBFC is failing to achieve the prescribed level within the stipulated period shall not be eligible to hold certificate of registration. So those NBFCs who are not following this rule 10 crore, so they would not be given certificate of registration. Now, for classification also it has changed. Now the NPA classification for NBFC is making the same just like bank. So in bank you have to wait for 90 days overdue to a period of 90 days. After that you have to make your assets classified under NPA. So similar to this, now NBFCs would also have to make it 90 days. But again RBI says that okay, we will give you glide path over here also. So you don't have to change it, uh, you have to change it gradually. So it was 150 days overdue, more than 150 days by the end of March 2024. Initially it was 180 days, then it decreased to 150, then 120 days to overdue by end of March 2025 you have to make it, and by the end of 2026 you have to match it with bank. That is 90 days or more. Then you can classify your assets as NPA. Now, this is important. So, ceiling on IPO funding. Now, ceiling is what? Ceiling means the maximum rate. And there is one more word that is called floor. So, floor means minimum rate. Now, so what is ceiling rate is provided 1 crore per borrower. Now, those NBFCs who want to raise fund through IPO, so for them, the those companies who want to raise funds through IPO, so for them, NBFC will provide the loan up to 1 crore per borrower to help them invest in IPO. The maximum amount they can lend to one person is one borrower, not more than that. It can be less than that, but not more than that. So 1 crore is the maximum amount they can. They can means NBFC can lend for IPO investments to companies. Now, next is what? Next is the transition path. Now, transition path means from lower level to the higher level. How NBFC will make the transition. If any NBFC is working under base layer, so how NBFC will move from base layer to middle layer, from middle layer to upper layer, or from upper layer to top layer. So for that, a path is to be followed, glide path is to be followed over here also, and that is a transition path. Now, so transition plan or transition path is what? It refers to a step-by-step process designed by RBI. What? For what? To help those NBFCs who are moving from old regulatory framework, means from old framework to the new one. If any NBFC is working under base layer, so how NBFC will move from base to middle layer, from middle to upper layer, from upper to top layer. So this is from old regulatory pattern to the new one, and this is not under scale-based regulation. Now, so why transition plan is created? So that it gives a time to NBFC so that they can adjust to new rules, they can follow stricter regulations, they can make their business more transparent, they can better manage their risk. And any NBFCs, this transition plan, it applies to in different NBFCs in different way. Why? Because every NBFC is different. They work on the basis of their size, activity, and risk level. So what is transition plan? It is moving from one layer to another layer. So if any NBFC is identified that now you would work under upper layer, so NBFCs will be advised about its classification. By whom? By Department of Regulation RBI. Now, for this purpose, RBI will provide the details. Now, so RBI will give 3 month time period. Now, 3 months time period would be given to read the policy properly, to understand the policy, to understand the strictness well, to prepare yourself to follow more strict regulatory pattern, to adopt the enhanced regulatory framework. So this is 3 months time is given. Now, after that, 24 months is provided. Why this is provided? To prepare the NBFC to follow the strict pattern from the date of advice regarding classification from the Reserve Bank, to prepare itself to follow new rules better, to how to work in the new regulatory pattern, what are the new things that you will have to face in next level, and how you can work, what risk you have to face, how you can minimize your risk, how you can assess your risk. So for that, 20 months time period is given. Now, there is one catch. What is this catch? In this 24 months, already the 3 months are included. It is not that 3 months RBI will give plus 24 months RBI will give. No, this is wrong. In 24 months, 3 months are included. So within 3 months of being advised by RBI, the NBFC shall put in place a board approved policy to adhere to the new set of regulations. Now, the period of then 24 months is provided. The period of 3 months in for making plan, for implementing the plan, it is subsumed within 24 months. Means it is already included in this 24 months time period. It's not that 3 months given, then 24 months given. No. In 24 months, the 3 months are already included. Done. Now, next is okay. This we have seen that how any NBFC will move from old regulatory pattern to the new regulatory pattern. Then, if any NBFC wants, if any NBFC has moved in upper layer, now if NBFC wants to move back to the base layer, then uh, what is the method? What is the way? So once an NBFC is categorized as UL, it shall has to follow the enhanced regulatory requirement. Now, it will be eligible to move out of this enhanced regulatory framework only when it fulfills a certain condition. Now, what is that condition? This is that condition. Now, if the NBFC is classified in upper layer and NBFC remains under that stricter regulatory framework for 5 years, so it can move out of that UL before 5 years also. But the thing is that the NBFC has uh, done its work. NBFC have reduced its risk. NBFC has operated its work in a less manner. Now, this relaxation is only avoided when NBFC has intentionally done this. Okay. Now, when NBFC's operation shrink because of problems like financial weakness, adverse situation, then no NBFC cannot move back to the base layer. Till 5 years, NBFC have to work under UL, and if NBFC fulfills the condition of base layer, after that 5 year the NBFC can be transferred to base layer. But if before 5 years NBFC have to be transferred to the base layer, so for that NBFC have to follow condition. Now what is the condition? That only if the change is due to voluntary strategic decision approved by board. When NBFC have changed its pattern, NBFC have reduced the risk, then only NBFC can move before 5 years. Otherwise, not. So this relaxation does not apply when NBFC intentionally shrink because of problems like financial weakness or adverse situation. So this point is very, very important. Now, If any NBFC that are close to meet the parameters of the next layer, so RBI will give the hint to NBFC that either you can reduce your operation, you can readjust your operations, you can reduce your risk, or second is you can make yourself, you can prepare yourself to follow the strict regulatory pattern of the upper layer or the top layer. So two things RBI will provide you. So RBI will provide intimation about the same. You can make it, you can be it in your same level by readjusting your operations, or if you want to continue, if you want to move to the next layer, then for that you have to prepare yourself. So these are the transitions of NBFC to the upper layer. Done. All right, now, so roles and responsibilities of CCO we have already done in the previous chapter, and the same thing is repeated here also in NBFC chapter. So I'm not going to repeat that because we have just now we have covered half an hour before we have covered the role and responsibilities of Chief Compliance Officer. Now, next chapter, that is unit number 32. So this is the last unit of your ABM. That is fraud and vigilance in bank. So before that, any doubt to anyone? Before that, now, so let's start the last unit, that is unit number 32. Now, what is fraud? So in this unit, we will study about the fraud, the vigilance types of vigilance officer, then punitive, detective. Okay, so all this we will study in this chapter, then different types of fraud as well. Fraud, cyber threat. Okay, this. Now, so what is fraud? Now, fraud, it has been defined under section 70 of the Indian Contract Act 1872. Now, in this, fraud means what? Anything which is done, which includes either it is done by the party or with his convenience or by his agent or with the intention to deceive. Now, in fraud, if the word intention is added, deliberateness is added, deliberate action is added, okay, to cheat someone or to deceive someone, then only that will be considered as fraud. So fraud means cheating someone intentionally. When intentionally word is there, then it includes when you are lying knowingly. You know it that this is not correct, but still you are lying to that person. You are hiding the truth. You are making fake promises. You are doing anything with the intention to deceive other person. And if the law says that this act is a fraudulent, if you have conducted that act, then it will come under fraud. Now, so Section 447 of Companies Act 1872, it defines fraud in a company affairs means doing something wrong. If you are hiding any fact, if you are misusing your position, if you are doing a wrongful gain or wrongful loss, if you are getting something by illegal means that you are not legally entitled to. You are not supposed to have that, but still you are having with any illegal means. So that is a wrongful gain. Okay, with the intention to cheat someone, getting an unfair advantage, misusing your position, harming the company, the shareholders, the creditors, or fraud can cause either wrongful gain or wrongful loss. Now, wrongful gain, it means getting something by illegal means if you have not entitled to, and wrongful loss means you have lost and you lost anything. Why? Because you have done any kind of illegal act. So when you had the right, legal right to keep it, you have lost that. So Indian Penal Code IPC 1816-70 Section 25 defines that a person acts fraudulently if they do something with the intention to cheat. If there the word intent is there, the word intention is there, that will be considered as fraud. Or if you are intentionally deceiving the person, harming the other person, that will be also considered as fraud. Now, what is forgery? So this is important. It is defined under section 463 of IPC 180. Now, forgery is what when you are making any kind of false document. If you have uh, if you have altered the document, like 10,000 was written, you have added one zero, or 10,000 is there, you have done like this 90,000, you have made it 90,000. So if you have done anything alteration in the document, if you have made the false document, the false record, or with the intent to damage the other party, with the intent to provide the injury to other party, so that will be considered as forgery. Now, so we have different types of cyber fraud. Now, mainly these are very important. Now, distributed denial of service is what means. It means that the you are accessing anything on the site, on the server of your computer, of your website, and your access has been denied. Now, when your access has been denied, so everyone is coming and seeing that why your access is denied. You are the employee of this bank, so access has provided to you, and meanwhile the fraudster from the backdoor will steal all the sensitive information. That is DDoS. Now, social engineering is what? The psychological, okay, physiologically and psychologically they will affect your brain. Means they will manipulate you, the fraudster will manipulate you in such a manner that you will reveal all your information to that fraudster. So it is psychologically, it is impacting. Now, man in the middle means there is the man, that is the fraudster, who is in the middle, who is creating the disturbance between the server and between the client. That is man in the middle. So if any client is having any knowledge, okay, if any client is working on the bank's server, so that client is working on the bank server, but in actual that client is connecting with you. That client has not connected with the bank server or with the bank's portal. That client has connected with you. So it means you are in the middle with the server and client. Now, so this is distributed denial of service. So that is attack to overwhelm the resources, causing other damage to other people. And meanwhile, from the back door, you will steal all the information from other person's computer. You are denying the access to the user. So social engineering attacks means instead of hacking computers directly, attackers will trick people. They will reveal, and the people, the attackers will manipulate you in such a way that you will reveal all the confidential data in front of that attacker. So this could be done phishing, spear phishing. Now, difference between phishing and spear phishing is in phishing, the target is the common people, the general people, okay, in general way. But in spear phishing, if the target is to any specific person, if to any specific people, that is spear phishing. So targeted phishing aimed at specific person, and it is to overall all the people. So through fake emails, websites that look real, but in reality, it is not a real. Now, homograph attack means homo means same. So if same type of websites are fake websites are uh, like the emails are provided to everyone, fake websites are sent to everyone, and all the people they are using the same type of website. So it looks like that it's the real website of the bank, but in reality, it's a fake website. Like you get an email that looks like it is from your bank asking you to verify your account. But in actual, it is not from your bank, it is from the attacker side. Now, man in the middle, so session hijacking is there between a user and server, between a server and the client by pretending it to be the user. So the user will work on the server and the server will pretend that it's the actual server from the bank. But in actually, you are connecting with the fraudster. Now, malware and spyware is what? So, malware, it is the virus, a sort of virus which is attached through links, through attachments, and when you are opening that, then it is redirected you to that page, to the fraudster page, and there you are entering all the confidential data, all the information of your account, everything. Now, so it includes different types of malware like Trojan virus. So in this, it seems that you have received a message from someone, or you have given the chance to enter in your system. You seems that okay, this is from your college, this is from your bank, so you have okay ticked a yes. Okay, it is written that confirm this thing. You have ticked it yes. Now that has entered into your system, that virus, and that virus is gradually attacking entire system. Now ransomware is what? That is the lock or threatening to delete your data. Means the fraudster will say that your data has been locked. If you will give me 10 lakh rupees, then only I will unlock your data. Otherwise, I will reveal your data in front of everyone, okay, everywhere. So that is what? That is a type of you are asking ransom, okay, in against that data or against that information. Now, malvertising is what? It is malware plus advertising. When malware is sent through advertising, through ads, okay, like you are visiting on any, uh, okay, you are doing anything on the phone, and suddenly the pop-up comes and it says that, okay, this is the link, this is the code, okay, you have got 500 coupon, or you can use this coupon in this particular website, and uh, you can get the cashback and all this. So that is what? That is a type of malvertising. Now, so password attack means simply asking your password, or you are uh, like you are using the password of that person. Unintentional act is there, and in that unintentional act, you are providing your own detail, your own passwords. So the attack, if you have given four numbers like 4132, now this is not actually your password, but attacker will use this password. They will try different types of permutation and combination, and they can get your password. So a hacker can gain access to the password information by an individual by sniffing the connection to the network. So a guess by with the guess, the attacker will break your password. Now, advanced persistent threat. This is most important. See, what is this? Now, advanced means a high level thing, means it needs a lot of time, it needs a lot of patience, it is a long term attack. And persistent means gradually and slowly, gradually or continuously. So, in this, what happens? See, suppose this is the attacker. Now, this attacker has entered into your system. Now, this attacker has entered into your system now. This attacker is doing nothing. This attacker has entered into your system. This attacker is watching your activities, okay, what you are doing every day, which websites you are visiting, okay, which information you are keep saving, or which data you are using, the primary data from unpublished sources, from published sources. So this attacker will try to, okay, the attacker will try to see what activities you are doing. Now, after a month or after 1 week, 2 week, this attacker will do its work. Okay. Now, so see what happens if every day, if something is happening, you are more cautious about that. But if in a month or in few weeks or in 15 days, in 20 days. If anything is happening, you're not very much worried about that. You're not very much cautious about that. You are saying that, okay, might be it is happening due to any server or due to any network issue. But this attacker is watching all your activities, and if you have taken pause from your work, or if you're not visiting that site for a long time, then that attacker will try to do its own work. So gradually and slowly the attacker will disrupt your whole system. The attacker will take your sensitive data. Okay, deliberately that attacker will avoid all the detection of the organization security. All the major efforts the attacker will try to do, but in a gradual way. So that is why the advanced persistent threats are known as the long-term threat. It is a targeted attack where hackers break into a network. The attackers will stay hidden for months or even years. Now, one more thing, this attacker will not going to attack the normal people. Like me, you, this attacker will not going to affect. This attacker will affect only to those people who are very you can say who the person who is having a lot of name and fame, a lot of money, big industrialist or big business, or you can say any minister. So these attackers will try to hack their account. So advanced persistent threat, very important. Now, so malware we have done, ransomware we have done. Now, what is RAM scrappers? So, a program that scans the computer's temporary RAM. So, RAM scrapper means this attacker will stay on your RAM, that is random access memory, a temporary RAM, a primary memory, and steal your sensitive information before you have been done any kind of encryption over there. Now, sniffing is what? It is secretly capturing data when you are traveling over a network, when you are using a free Wi-Fi, then this act is done and the fraudster will steal all your information. Now, spoofing is pretending to be someone or something else to trick the people. So, actually, that person is not your bank or not your bank employee, but that person will try to say that, okay, I'm from your bank. Okay, your debit card will get blocked. So, tell me your password and all that. So, that is spoofing. And phishing, we have seen that is when tricking people, the all the types of people, the common people through fake email IDs or websites. Now, smishing is SMS plus phishing. Wishing is voice plus phishing over the phone, and it is on the through SMS. Farming is what? That is again, it seems that you are visiting the real website, but in reality, that website is not real. It is the hacker's website. You are working on that hacker's website. So, like you type www.mybank.com, but instead of going to the real site, you are redirected to the likewise site. Now, next is central payment CPFIR, Central Payment Fraud Information Registry. Now, what it says that? It says that if any bank or if any customer has detected any kind of fraud, so customer and bank should report all the frauds as soon as they are happening. So near real-time reporting should be there. Now within 7 days rule. So to start with, RBI has made it mandatory that all frauds must be reported within 7 calendar days. Now either from the date when the customer is reporting or when the bank has detected the fraud. Like bank has detected the fraud on 25th of November. So from 25th to within 7 days, the frauds should be reported. And as long as you will take time to report your fraud, the actions would not be taken very quickly. The actions will also be delayed. So that is why it is said that as and when you have detected any fraud, report it instantly. Now, change in platform is what? So before January 1st, 2023, reports were submitted to EDSP, that is Electronic Data Submission Portal. Now, after January 1st, 2023, it has been shifted to Daksh platform. Now, FMR, that is fraud monitoring return. So remember, before it was 21 days, three weeks. But now all the banks and regulated entities they has to file fraud monitoring returns as and when the fraud they have detected, but it has to be reported not later than 14 days, means within 14 days when the from the date of classification of the account, or when the fraud has been, when the incident has been took place. So from that day to within 14 days, the FMR, the fraud monitoring return, should be filed. Now, so before it was 21 days, but after the RBI master circulation, it has been changed from 21 to 14 days. So now it is 21 to 14 days. Now, so banks must send all the flash reports to RBI. So flash reports should be sent to RBI within 1 week when a fraud of rupees 5 crore or more is found. And it has to be updated. All the banks must also keep updating the RBI about the flash report, about the progress of the fraud cases through one system that is known as XBARL system. So FMR update system. So this is important, fraud of 5 crore or more. Now, next, a special committee of the board. Now, see, already we have a audit committee of the board. You have seen. So where all the frauds, risk are being reported to ACB. Now, if any fraud cases, the fraud amount is 1 crore or more than that, then for that a special committee of the board is the special committee of the board has to be reported. So this board will review all the frauds and take the action. So this is the special group within a bank's board of directors, and it is created only to look into the big fraud cases, that is 1 crore and above. So RBI noticed that large frauds, they need more monitoring, that is 10 million or equal to 1 crore. So apart from ACB, bank must form a special committee to report all the cases. Now, in this STB, there are total 5 members. One is MD and CEO for public sector bank. MD is for SBI and private banks. Now, 2 members are from audit committee and 2 members are from the board members. But in this board member, RBI nominee is not included. So committee must meet whenever a new fraud of 1 crore plus is detected. So all the information will be provided to this special committee of the board. Now, so loan frauds, that is a red flagged account. Now, so red flagged account is what? It is the loan account when the bank sees the early warning signals, and to report this, all the frauds cases are reported under red flag account. So it could be any kind of irregular payment, sudden changes in business pattern, or suspicious transaction. So as and when the EWS bank has detected the early warning signals, the bank will treat all the accounts under red flag accounts. Bank should not ignore it. And how much is the amount? 50 crore or more. The bank must apply these EWA RFA checks no matter if the loan is given just by bank, or the consortium loan is there, or loan syndication is there. So if the amount is 50 crore and more, it must be reported. Now, what is vigilance in bank? So vigilance is what? It is the process, it is the measure that is taken to prevent the fraud, to detect the fraud, to take strict action against the fraudsters who is indulged in this activity. Why? To ensure transparency, accountability, and ethical practices. So we have 3 types of vigilance: preventive, detective, punitive. Now, preventive means when you know that might be this kind of activity will going to happen in future. So before that, you are taking actions. So preventive is steps taken to stop fraud and misconduct. Like you have seen that in XYZ bank, such kind of fraud has happened. Okay, now you are taking the preventive measures. So in your bank, no any kind of fraud should take place. So that is what preventive vigilance is. So it is a proactive measures. Now, detective means fraud has already took place. You are finding the irregularities. You are identifying the frauds through monitoring internal audits. So that is detective. So it is reactive in nature. So after the fraud has happened, after, then fraud took place. After that, you are taking action. That is reactive. Now, punitive is you are taking action against the fraudsters, against the individuals who are involved in this fraud. So that is punitive vigilance. Now, next we have what that is a participative vigilance. So participative vigilance means what? See, vigilance officer means those who check all the details, all the um, things, all types of fraud that is happening. So Chief Vigilance Commissioner is at the national level now, and for this participative vigilance, because the vigilance officer will check all the things related to fraud, so it will work always at the apex level, having a lot of independence. The vigilance officer can take independent actions. They can participate in any of the matter which is related to fraud. And the Central Vigilance CVC, it is set up by the Government of India on the recommendation of Committee on Prevention of Corruption. And this Committee on Prevention of Corruption is known as the Santhanam Committee. This is important. All right. Now, next is what vigilance angle. Now, what is vigilance angle? So, vigilance angle is if your CVO, that is Chief Vigilance Officer, decides that if any case is having any vigilance angle or not. If the case is having vigilance angle, then strict action would be taken. If the case is free from vigilance angle, it means no frauds are detected in that case. Now, so how we know that the case is having a vigilance angle or not? So if it involves all these things, like you are taking bribes, okay, you are getting valuable items unfairly, using your advantage of your position, having assets that don't match income, like from other sources, you are making money illegal in an illegal manner, or if any kind of criminal offense, cheating, forgery is there in the cases, it involves corruption, illegal gain, unexplained wealth, and all that. What that is will come under vigilance case. Now, so there are total 12 sutras for effective management. Now, 12 sutras for effective fraud risk management is what? That one should implement a robust framework, means that you should look carefully with all your eyes open. You should prevent the fraud. You should properly identify the risk, and whatever mitigations you can take, you should have to work in all the sensitive areas. Then follow 5 C's of credit. So this we have seen in management appraisal also. The capacity, capital, collateral conditions, characters. Promote a vigilance culture so that the officers they can take best action. Don't use the technology, okay? Because human intervention is mandatory over here. Humans can do further activities. You cannot every time rely on technology. Then implement all the checks and balance to manage risk associated with staff turnover. Don't wait for the activity that when this fraud will going to happen, then the action will be taken. No. So make your employees, make your people so much strong that they can handle any activity, any type of fraud. So provide fraud risk managers the authority, the tools, the practices so that they can take effective measures. Use 3 C's of fraud information, that is CFR, CRELIC, and Credit Bureau. Properly utilize market intelligence, that is, if in the market the same type of fraud is happening or not, it is prevailing in the market also, then you have to prepare it before, you have to anticipate the problems. Okay, use your data analytics tool to make informed decisions. If early warning signals are there, take prompt decisions. Don't just if you know that this particular thing will not benefit you, then don't waste time on that. So avoid your sunk cost fallacy, avoid sunk cost error. So don't wait on that project or investment that it will give you the returns. No. And ensure better compliances so that you can maintain integrity in the banking system. Now, next, how if the chief of internal vigilance is there, what is how we can appoint the chief internal vigilance? What are the role and functions? So, appointment of CIV is done on the basis of experience, the track record. Uh, Now, so appointment of CIV in private sector foreign banks. So basis of appointment is what, that you will see that whether that officer, chief vigilance, is having a good level of experience or not. Then what is the tenure? So normal tenure is that CIB would be 3 years. So normal tenure is 3 years, but it can extend up to 2 more years. Means total 5 years are given. But if any CIB has left the bank and the CIB has been transferred to another bank, so in that case, total 6 years the CIB would have to work. But if a CIB has to shift from one bank to another without completing the approved tenure, then the overall tenure would be 6 years would apply over there. If not, then 5 years would stay. So association would be, so CIB should take better decisions on all the sensitive matters. Then reports should be submitted properly. All the chief internal vigilance officer will review all the pending case, and all the complaints and reports would be submitted first week of every month. And there is staff rotation. So if the officer is not available, then in critical roles, the chief internal vigilance officer can do the work in place of the in absence of that staff. Now, next is what, that is check related fraud. So in check related fraud, one has to mandatorily take care that one is following the CTS. CTS is what, check truncation system, and this came in the year 2010. So use only CTS 2010 for standards check. There should be no any kind of duplication of checks. It provides better security features, improve check processing infrastructure. So that is, your staff should be well trained. Well, you should have good level of staffs. Okay, you should have good quality machines so that they can check the authenticity of the check. Then beneficiary has completed, so KYC is done or not, to whom the check has been issued. Check high value checks under a UV lamp, means if any check is having the value more than 2 lakhs, it should be verified properly if there is any kind of hidden security features or not. Now, when fraud happens, so if bank staffs are not involved, and the fraud, it is the amount is lying from 25 crores to 50 crores, then case will go to the banking security and fraud cell. But if the amount is more than 50 crore, then it should be reported to joint director at CBI, Central Bureau Investigation, headquarters, New Delhi. So if the amount is more than 50 crore, CBI has to be informed. The reporting should be provided to CBI. If the check lies from 25 to 50 crore, then the BSFC. Now, and multiple level checks are important if the check is having the value over 5 lakhs. If any new account is opened and the check transactions are happening very high, means money quickly debit and credits are happening in the small interval of time. So you have to identify those accounts properly. SMS. So before clearing the check, the bank should provide the SMS alert, okay, to the person issuing the check when it is presented for clearing. And the numbers, the value limits, the 5 lakh, 2 lakhs, it can be changed depending upon the circumstances. It can be changed by the bank codes. So it's basically what, a mixture of technology. So you have to analyze properly, you have to check the real time alerts and make strengthened actions related to checks if any kind of fraud is happening related to checks. All right, so these are all the things that are related to checks. And with this, we have completed our entire three modules, that is B, C, and D. Any doubt to anyone so far? All right. Now, so already those who have not watched the yesterday's session, so yesterday we completed 13 units so far, and today the rest of the units we have completed. And module A, this is not on YouTube, it's on the paid classes because I'm taking only three modules, B, C, and D. and A module Ajay is taking on paid classes. So that is why it is not available on YouTube. All right. Any doubt to anyone? And please do let me know your scores, okay? After giving your exam. So all the best to everyone. And see, out of 100 questions, see, it is the tendency that not every 100 question would be of your syllabus. So there might be 5 to 10% of the questions that will always come out of the box. So don't panic when any question confuses you. Move to the next question. Okay, just give a random guess. Just take the random guess and move to the next question. Don't waste the time on any single question finding the answers of that. And out of 100 questions, so there would be 5, 7 questions that would be entirely different out of the box. So don't waste much time on these questions as well. So because you don't have to bring a all India rank, you have to just qualify your paper with good at marks. All right, chalo. So all the best to everyone, and we'll meet tomorrow with paper analysis at 11:30, and please do tell me what type of questions you have faced in exam and your marks as well in the comment section box. All right, chalo. So bye bye everyone, take good care of yourselves, all the best to everyone. And after the session gets over, I'll upload the PDF, so don't worry about the PDF. If you have downloaded the Oliveboard app in your phone, then you can easily download all the PDFs. So yesterday's session PDF is also uploaded, and today I'll upload after the end of this session. Okay, chalo. Yes, yes, thank you. Thank you everyone for watching this session, and we'll meet tomorrow at 11:30 a.m. for our paper analysis. All right, chalo. Bye bye everyone. Once again, all the best to all of you.